Well, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Stocks on the S&P 500 look a little something like this, just about positive on the S&P this morning. Good morning to you all. Positive by 0.03%. On the NASDAQ, up a little bit as well. Stocks going 3 days without gains on the S&P 500, Lisa. There haven't been major moves lower, but just 3 days without gains. Maybe equities meeting gravity just a touch over the last few days.
The idea that maybe what's giving a bit of a boost to bonds, yields lower, is not the greatest thing in the world for equities. Are we reaching the point where bad news is bad news? I don't know.
There we go. Show me some bad news.
Well, I mean, the implied
productivity, those numbers were great. ADP was a little bit softer, but still decent. Payrolls, what are we looking for? 180 on Friday. ISM, robust on the headline. Prices paid a little bit lower. Job openings came in lower since March 21. I mean, isn't that what we wanted?
You know, that's a great point. Is there some implication that this is a little bit too cute? This idea that we're going to get perfect disinflation without any slowing down in the economy. And maybe that's the reason why you're seeing a pause. They're not massive declines, just a little bit of a shift from the everything rally that we saw in November.
This is what spooks people. Let's get the bond market up. 2-year, 10-year, 30-year. There will be a moment where that yield drops too much. And then people start to say, oh, okay, slow down. I don't know where that is, Lisa. 4.1% yesterday seemed to get people's attention. We're up 5 basis points this morning. But when we're at 5 plus, we were talking about yields crushing the economy. Now we're down at 4. We're talking about accommodation. At some point, you'll get the bears coming out screaming and say, look, the bond market's screaming, end of cycle.
TD Securities and Peter Scher over at Academy both are pointing to sub 4% as sort of the line in the sand where people start to get nervous. So that's why I'm actually curious. Is there a line in the sand where suddenly people start to say, this means something, and it's not positive?
There was a line in the sand in crude yesterday. It was a break of 70 into the 60s. That woke everybody up. Here's the price right now. WTI, Brent, WTI, $70.01. We're positive here by 0.9%. Yesterday was intriguing for me and for many others as well, Tom. I'm not going to offer my opinion about where we are. Paul Sankey's going to do that for us in about 15 minutes' time. But you see crude drop into the 60s. And to hear the crowd come out and say, yeah, this is about economic slowdown. Well, what's going on with stockpiles in America? Why are they getting drawn if we're talking about a slowdown? We've got production at 13.2 million barrels a day in America, and stockpiles are being drawn in the United States. Try and make sense of that with crude in the 60s.
You can't, because Sankey owns the high ground on this, the microeconomics of oil, and its supply and demand. The variabilities are so tight, they are so small that little bitty changes really can move price. Now, I'm watching Brent crude there at 75 more, but can you imagine global oil at $69? And how does that upset the various apple carts in the Middle East?
But this is the reason why I think a lot of people aren't necessarily seeing this as bad news. Maybe this just feeds into the perfect immaculate disinflation, because we've got record air travel. We had record amounts of travel for the Thanksgiving weekend in the United States. We're seeing a drawdown on inventories. Yes, you're seeing the slowdown in China, but we already know that, and that's frankly starting to show signs of reversing. So is this just supply from the U.S. and the fact that there are more efficient uses of energy? I don't know, but this is kind of how some people might read this.
So this was the main event yesterday. Let's talk about the main event this morning. Under surveillance this morning, traders rapidly increasing bets that the Bank of Japan will scrap its negative interest rate regime and hike as soon as this month. The BOJ governor saying handling monetary policy will get tougher going into next year, while the deputy governor presented, Tom, a hypothesis for what might happen if the central bank were to end negative rates. Dollar yen gapping lower. That's a much stronger Japanese yen this morning.
It is, yes, it's there, but what's really there is OBE. They are massively becoming overcome by events. And the overcome by events is what's going on in Europe, what's going on in America, Is it a domestic story? I'll let Robert Feldman at Morgan Stanley help me with that. It's an international story. They're overcome by events.
Yeah, they're overcome by the fact that the U.S. and Europe might cut rates, which gives them an opening not to be too disruptive if they do end their negative rate policy. Just saying, what did the hypothetical actually sound like? There would be sufficient possibility of achieving a positive outcome from the exit, since a wide range of households and firms would benefit from the virtuous cycle between wages and prices, especially given that they're getting income. Suddenly, this is a whole new world for the Bank of Japan.
December 19th, the next BOJ decision. That might be fun, going into the Christmas week, the week after. 4 candidates taken to the debate stage in Alabama, but just one in the firing line. Nikki Haley, the former UN ambassador's campaign, receiving a boost in recent weeks with support from wealthy donors.
Her donors, these Wall Street liberal donors, they make money in China. They are not going to let her be tough on China, and she will cave to the donors. She will not stand up for you.
First of all, he's mad because those Wall Street donors used to support him and now they support me.
Nikki, I don't have a woman problem. You have a corruption problem. And I think that that's what people need to know. Nikki is corrupt.
Governor Haley, would you like to respond?
No, it's not worth my time to respond to him.
TK, if you didn't like hands up, what do you think of people writing things on a piece of paper and holding that up?
I think America's exhausted by this. America sees cumulative inflation, and they also see cumulative political stupidity. Republicans, Democrats, disaffected, those in the middle, they're just like, everybody, I'm being ecumenical here, everybody grow up.
Well, all I can say is that that particular candidate is looking to out-Trump Trump. And maybe that's the kind of method.
Is he a legitimate candidate?
It's a good question. I don't know the answer to that.
He's still on the debate stage.
Precisely.
One of 4.
Will this happen in England? Tell me no.
I think we've seen crazy politics all over the world, Tom, over the last 12 months, haven't we?
I think America's exhausted by this. Half the nation has fallen behind. We don't need to bore people with it right now. But the bottom line is there's an exhausted America from pandemic inflation that's like, we don't care. There's only one issue.
It's only a few years ago we had Jeremy Corbyn. TK,
that's true.
The UK.
Well
Come
said.
On, before we look down our nose about what's happening in America.
That's British. When I say proper, I've learned that.
That's a proper response, apparently. All right. Meanwhile, in Washington, President Biden urging Congress to approve additional aid for Ukraine before the Christmas break. Biden's saying he's willing to consider changes to immigration policy to secure a deal and warning of the consequences of failing to approve more funding.
If Putin takes Ukraine, he won't stop there. It's important to see the long run here. He's going to keep going. He's made that pretty clear. If Putin attacks a NATO ally, if he keeps going, and then he attacks a NATO ally, well, we've committed as a NATO member that we defend every inch of NATO territory, then we'll have something that we don't seek and that we don't have today. American troops fighting Russian troops.
It's a shocking warning from the President of the United States. In the last 24 hours, we were talking about, Tom, 2 proxy wars for the US at the moment. They're in one currently with Russia, and potentially in another, a lot of people would say they are, with Iran.
You know, there's 2 wars going on here, but there's a 3rd war going on as well, and that's the headlines that were not mentioned there by the president, which is Mr. Putin in the Middle East. And the answer is this is a set of movable parts. It's just, I get it. Ukraine is a cookie-cutter domestic issue. Capitol Hill, Mitch McConnell's lonely in the Senate. That's the zeitgeist. Guess what? The real issue here are the movable parts. John, as you say, 2 wars, and also Putin is it shuttle diplomacy? I guess it is.
Well, to me, I just want to understand exactly what the details are and the border control issues that's holding up some of this spending, right? I want to understand exactly where the push and pull is, given the fact that there does seem to be some sort of consensus that there needs to be something done. At the same time, what is so outrageous that Biden can't get behind it, and what would Biden sort of be willing to allow in order to get this funding through?
We'll touch on that a little bit later this morning, I'm sure. Let's get you some outlooks. Let's get Kathy Jones at Charles Schwab, the outlook on the fixed income market. The case for lower interest rates in 24 is straightforward, but the path is likely to be rocky. We expect bond yields to decline in line with falling inflation and slower economic growth, but uncertainty about the Fed's policy moves will likely be a source of volatility. Tom, nonetheless, we are optimistic that fixed income will deliver positive returns next year.
The positive return is the heart of the matter in the change of 2023. Kathy Jones joins now, Chief Fixed Income Strategist at Charles Schwab. Kathy, we were over at Apollo Global Management earlier this week. They have a 7-year, multi-year annuity yielding 5.70%. Lock it in for 7 years. How does the rest of the world compete where yields are right now?
Yeah, I think that's a great point, Tom, that right now when you're looking at, say, investment-grade corporate bonds or some sort of mix of higher credit quality corporate bonds and treasuries, government bonds, MBS, et cetera, you're locking in yields in the 5 to 6% range. And if you are a municipal bond investor in the highest tax bracket, you could be looking at 6 to 7% tax equivalent yields. So it is tough to compete. Nonetheless, the rest of the world seems to be competing. But right now, fixed income still offers some pretty attractive returns for people over an intermediate term time period.
Why is there a bigger sell-off in the bond market today on the heels of some of the rhetoric out of the Bank of Japan officials last night?
That's a really interesting question, Lisa. I was wondering that myself. We've long waited for this moment when the Bank of Japan exit yield curve control. And there is some concern. I think I would be concerned in the funding markets and if there's some spillover effect. But I guess we have gradually gotten accustomed to the idea that Japan will do this at a time when yields are falling elsewhere in the world. So maybe that's a bit of an offset. I'm still a little bit nervous about that as a potential source of volatility in the market.
Well, especially given the fact that this was one of the many narratives that people were putting out there to justify why 10-year yields rose to 5% earlier this year, say, a month ago. A lot of people were saying it's not just the Bank of Japan abandoning yield curve control, it's also the deficit, it's also the fact that we're dealing with government dysfunction, all of which is still very much in the picture. How much could this conspire to cause yields to go higher from here and not necessarily so much lower?
Well, I think the question you have to ask is yields are 70 basis points lower since all that narrative hit in November and nothing's changed. So was that really the story that drove yields up? I think there were a lot of contributing factors there, but I think also that was an overreaction to a lot of issues. And frankly, at the end of the day, when you run correlations between bond yields and various factors, inflation and inflation expectations tends to be have the highest correlation. And that's really what's changed here is we have gotten, lower oil prices. We've started to see more in the way of disinflation on the consumer side, slower labor force growth, which would tend to indicate less consumer spending or less inflationary consumer spending. And those are bigger factors than the other things that you cited, particularly supply.
Kathy, have we come so far so fast that we've given up on total return and it's a clip the coupon 2024?
No, I don't think so. In our report, we ran some scenario analysis. And if yields stay where they are, then you're clipping the coupon, right? But even a modest decline from here, you're getting that added total return in terms of price appreciation. But frankly, clipping the coupon at 5% or so isn't such a terrible thing for most investors.
Kathy, thank you for your perspective. Kathy Jones of Charles Schwab going into payrolls Friday. Let me share some of the numbers with you. Jobless claims coming out a little bit later. 220 is the estimate. The previous number's 218. Looking at the payrolls report, the estimate in our survey at the moment can change, of course. More estimates still to come between now and tomorrow, potentially. 185 is the estimate currently, Tom. The previous read, 150. Within that, something like 30 to 40K coming off the back of the UAW agreement, but still pretty healthy stuff.
It's healthy stuff, and everybody's got a game here about where we need to be on claims. I think we need to be 270, 280. We're nowhere near that. And on non-farm payrolls, I'm going to go to David Kelly at JP Morgan, who I think is brilliant on this. You got to come down under 100,000. Again, we're nowhere near that.
But that to me raises the question of BNP Paribas. This is the no landing scenario. This is disinflation without real pain that, frankly, you heard Jay Powell promise us, in 2022. So if that's the case, is this a good thing for stocks or a bad thing if that means that yields are going to remain much higher than people expect for a longer period of time?
We've got to ask the same questions about what happened in crude yesterday. We're going to turn our attention to the commodity market. Yesterday, WTI breaking down into the 60s. The first time we've seen that kind of level yesterday since June. What's going on with crude? At the moment, just in and around 70 at 69.94. Coming up very shortly, Paul Sankey of Sankey Research on crude. Trying to explain, Tom, some of the moves we've seen in WTI and Brent over the last few months. We're talking about 25% moves from September, Tom. Lower, big moves.
And the domestic store in Sankey is expert on Texas and the Permian Basin, so we'll fold that in.
That conversation just around the corner. Equity futures on the S&P going absolutely nowhere. You know the calendar. Jobless claims a little bit later this morning. The big one, the payrolls report, about 24 hours away. From New York, this is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We actually have 4 separate facilities, 4 separate sites for our Strategic Petroleum Reserve. So we will be doing at least 3 million barrels, and we hope we can bring more capacity online at these price levels to buy as much as we can to refill to make sure we've got that available when we need it in the future. So we'll buy as much back as we possibly can, but there are some physical constraints.
That was David Turk there, the U.S. Department of Energy Deputy Secretary, speaking early this week from COP28 in Dubai. If they want to buy, they've got a big opportunity right now. We dropped back into the 60s in the last 24 hours on crude. The price action right now looks like this on WTI and on Brent. Crude 69.92 on WTI. We're positive by 0.8% on the session, but Tom, still in the 60s on WTI. On Brent, it's a break of 75, 74.94 currently, up about 0.9% on the session.
And what's so different here is the U.S. dialogue, as Lisa alluded to earlier. I think, John, a huge body of Americans, including me, don't understand our somewhat independence here. We've got all these images from the past that are out there.
I'm looking at the number right now, Tom, 13.1 million barrels a day.
Americans don't perceive
I think it was 13.2.
Maybe they do if there's an oil rig.
Just a little bit, but still north of 13 million.
Lisa's summer place, she's got an oil rig in the backyard. You know, one of those things going up and down.
What is your thing about me with oil in my home? I mean, yes, I'm just spewing oil. You know me, the Brahma oil spew.
But the answer here, John, is Americans.
What are those things called?
The rigs, right?
No, there's a specific name for them. What are they called?
They look like
the thingy.
Go on, the thingy. I know what you're talking about. Paul Sankey knows. Ask Paul.
You drive to LAX, you do this, but
you just see them go up and down.
I think that, folks, seriously, there's no other issue we talk about where we've all got various institutional and learned memories which are wrong to make us smarter. Paul Sankey joins right now, founder, lead analyst at Sankey Research, with one of the most read notes on the street. Paul, I want to go to the madness of 1986. OPEC absolutely blew it in 1986 with a price plunge. Can we get a redux on that again, and particularly with the new American production of oil?
It's not 86 now, and by the way, it's a pump jack. And Lisa should think about the joke that's kind of more realistic is you use your swimming pool to store oil, but you need contango. You need contango for that swimming pool trade, and we're in backwardation. So 86 not the right one to be honest, Tom. It's that was when OPEC increased into the Asian financial crisis, and it's quite the opposite here. What we've got here is the 2014. Probably not a 2020, but in both cases, that's where Saudi flushed the market, essentially because they got frustrated with cutting back production to maintain prices, such as 2014 being the really excellent example. What was happening is they were losing market share, particularly to Iran, which was coming back through sanctions. And you had, of course, the growth in US production that was squeezing Saudi from the other side. And then in 14, they essentially couldn't get the rest of OPEC to agree with them. They dumped the market, they flushed the market. We went in a straight line from 110 in summer to 50 by 2015 January. So in 6 months, we cut in half. And then we bottomed again, if you remember, in 2016. I don't think COVID, the 2020 market share war, which was more extreme, Saudi went to an all-time high level of production in 2020, which was in April 2020, which was truly praised in a lot of ways because, of course, it made for negative oil prices in the US. But here you've clearly got a situation where Saudi has cut production and is facing a very strong demand environment. So it must be extremely, and in fact, an all-time record demand environment. It must be very frustrating for them to be losing market share to Iran and, as John mentioned, to a absolutely booming US industry. And I think everyone's turned negative oil, not least because the US has accelerated this year into the second half in terms of production and, taken more market share from Saudi. So our concern is that Saudi said they'll push through Q1 with cuts, but by the time you get to Q2, and if demand isn't strong enough seasonally, you could see Saudi dump the market and try and make everyone honest again. I think that's the analogy.
Paul, I just want to be really clear about where we are right now. There's a lot of people trading equities, economists making recession calls. You think this is about supply and not demand right now, currently?
I don't know how you can get higher demand than all-time record demand. Now, having said that, because we're 102.5 million barrels a day, we're at over 1,200 barrels a second of demand. So I think the demand side's pretty much good. And China's been pretty good in the second half too, which was always the balancing item in terms of bullishness in oil. And keep in mind, of course, John, that it's seasonally a weak time for oil here. So we're dumping into, the traditional post-Labor Day weakness. And we'd actually think, whilst we're worried about the Saudi market share war, we can see a bounce here in oil. Distillate demand here remains very strong. It's cold this morning in Brooklyn, but more importantly, it's cold in Europe. And, I think we're a bit oversold in oil here. Doesn't change the fact that we think there's a structural problem in the market, which, exactly as you say, is too much supply and too much spare capacity, particularly.
Well, but Paul, I want to just develop. You think that we're oversold here, and yet you think that there is a good chance that Saudi Arabia flushes the market, increases production, goes away from some of those cuts to, as you said, make everyone honest again. In that case, how low could prices go?
Well, it's an interesting question because what you're trying to do at that point is shut down US supply growth. And that becomes the knotty debate. That's the analysis. That's the Permian question. Because, of course, what Saudi's trying to flush at this point is going to be Exxon, Chevron, Conoco. It's not your old school E&Ps with a lot of debt that kind of collapse at the first sign of trouble. And, of course, all these companies have basically planned at $60, maybe less, in terms of what they're doing and have growth targets that they want to meet. So I think it's going to be a more inelastic supply side for the Saudis to attack. Additionally, in 25, we're adding 8 FPSOs, that's a floating production and storage vessel, which are very big in places like Guyana, Senegal, and those are very price insensitive as too. That is to say, once you've built your huge production vessel, you don't shut it down because oil's at 50. So it's a fascinating market. And by the way, Tom, going back to 86, the whole peak oil question is like, what were you talking about? The supply side has got excess capacity at 102.5 million barrels a day of demand. It's like, what? I think a lot of it is technology and AI, actually, seriously.
Paul, I'm very proud to say I didn't believe in peak oil for 1 minute. That's maybe one thing I got somewhat right. Paul, we see Mr. Putin on a junket to Saudi Arabia with Mohammed bin Salman. What's the dynamic there? Do the Saudis tell the Russians what to do in the Paul Sankey world?
I think they ask them for help for sure. The problem is the Russians lie, right? I mean, whatever they say is like whatever they say. I don't know how much they really do. It's possible that they realize that there's enough of a problem and that they want that relationship with Saudi to be good, that they do get on board. And I think it is very significant, obviously, that Putin's meeting MBS, because there must be some quid pro quo here. We suspect, and we really don't know, that the Saudis have also asked the US to tighten sanctions on particularly Iran, but also Russia, obviously, because those have been two other major problems for the Saudis. The US has essentially been allowing a lot of additional oil onto the market into an election year. We think that maybe the Saudis have said, if you tighten sanctions, we'll make sure that the oil price doesn't get too high for elections. But of course, then the complexity is, do the Saudis really prefer Donald Trump? So, you know, I'm not sure about that speculation, but certainly there's been evidence the US has been tightening somewhat the Iranian and Russian sanctions, which would help Saudi.
Paul, didn't they try that going into the midterms last year?
Try to tighten sanctions or try to
get the Saudis to boost output to get crude prices lower?
Yeah, I think Saudi-US relations have improved over the last year for sure, and I think through the Hamas, nightmare, we've seen obviously a lot of work from Blinken to try and get everyone back on the page. Now, of course, it's said in the press that the MBS actually kept Blinken waiting for quite a long time at a time when he was insanely busy, which I'm sure he didn't appreciate. So I think they're still sending messages that the original language of this administration, which you'll remember well before the election when Biden was very negative about oil and very negative about the Saudis, they don't forget that stuff easily. But at the same time, they're very pragmatic people. I think they realize that the US is hugely important to them. We've subsequently had security agreements between Saudi and the US.
Yeah.
So it's really complex, and I think a lot of people are saying a lot of things to there's a lot of multipolar world going on here. I don't know how much they really truly love the Russians as well. I mean, the history of that relationship is nothing like the quality of the history of the US-Saudi relationship.
Well said, Paul. Appreciate the explanations this morning. Thank you, sir. You're one of the best. Paul Sankey of Sankey Research. Nodding donkey. Guy Johnson, thank you. Not pump jacks. I mean, I know that's the official term, but nodding donkey. Nodding donkey.
That is so accurate.
Nodding donkey. That was what I was searching for.
A nodding donkey.
A nodding donkey.
Nodding
Never heard that.
donkey. You never heard that?
Never heard that.
Okay.
Automated donkey. Sort of like a R2-D2.
Yeah,
donkey.
something like that. Something like that. Okay. If you're just tuning in.
That was informative.
If you are just tuning in. There was reason for that. And Maletti of Allspring Global Investments coming up.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lines.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg. your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
There's still room for inflation to keep coming down without any need for really growth to slow.
Inflation's bounced around some, but if you take a step back, it's clearly on a glide path down.
Is this as good as it gets for inflation? For the moment, this is perfect.
If the Fed doesn't start cutting in March, I think they're going to have a harder landing.
Rate cuts in the first half are unlikely. We'll see what the second half brings.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Is this as good as it gets? Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P just about positive. TK, Lisa and I asked the question a few times yesterday. Can the growth inflation mix get any better than this?
I'd fold in a jobs report. I'd take growth inflation mix. I think all that's important, but I'm going to go to Torsten Slok on our visit to Apollo Global Management a few days ago. It's a double barrel. Yes, it's tomorrow's jobs report. Claims is as key this morning as it's been in ages.
The estimate for claims 220 for tomorrow, Lisa, 185 in a payrolls report.
This is going to be still a not terrible jobs market, which raises this question going back to, is this as good as you can get, especially with disinflation that you continue to see in lots of different places, including in the oil market. And to me, I think this is sort of an odd tailwind to come at a time when there still is record demand. There just is also record production and more efficient use of energy. But is this the secret sort of disinflationary force that could really drive this narrative even further?
Some bullish framing from Bramo.
For the moment, not necessarily.
I'm
exploring all potential options.
I'm with you. Look, you've got crude in the 60s. You've got a 10-year at 4.1%. Ask someone what that means, Tom, and you'll learn a lot about them. There'll be one group of people who will say, that is an economy that's going to slow down. That's what we're pricing in. Another group will say, we're foaming the runway for a soft landing. This is going to help us re-accelerate into 2024.
So your tweet yesterday, John, your tweet yesterday on this was brilliant. You really captured this yesterday, this massive ambiguity we have trying to put together the dynamics of the moment. So you say, what is the single feature, the single distinction in that debate? And I'm sorry, I got to go back to, Surveillance 101. It's China. If China underperforms, boom. If China's average, a different scenario, what if China surprises to a 5% or more GDP?
Well, China underperformed this year. Just America outperformed in a massive way. Let's take one security. Let's take one price. Let's go to crude. WTI, 69.69 on WTI crude this morning. What is that telling you? Is that about weaker demand, perhaps now or in our future, or is that just about booming supply? I'm not going to answer that for you. Paul Sankey just did 10 minutes ago. Paul Sankey, Sankey Research, Bramo, coming out and saying that is all about supply. Demand is totally fine.
Given the fact that it's at a record high and they point to U.S. production and Iranian production, that conversation was fascinating. This idea that Saudi Arabia is trying to get everybody on board with production cuts to get the prices up, and they might just get so frustrated that they'll flood the market with supply, they'll abandon their cuts, and they'll say, all right, let's see how low we can get these prices. How do you like that? This, to me, is such an interesting narrative. I imagine the Biden administration won't mind it. That's the interesting thing, given that it's heading into election cycle.
They will whisper that production is north of 13 million barrels a day. They won't even say it may be, but they'll scream about where crude is right now and where gasoline prices are going.
Given the fact that this typically is pretty correlated to sentiment and gives, at least the University of Michigan Sentiment Survey, and gives a forward look to inflation. All of this paints into this rosy glass narrative that some of the signs that previously meant weakness now just mean it's okay.
It's the second time you've sounded constructive in 3 minutes. Where's Bramo?
You've been asking that all week.
Find Lisa.
Well, we'll find her
Where's
somewhere.
Bramo? 69.70 on WTI. The prices elsewhere, the price section of scores look like this. On the equity market, on the S&P, going absolutely nowhere. Yields a little bit higher on a 10-year. Lisa up 5 basis points. We're back to about 415.33.
So we are in the drumbeat to non-farm payrolls tomorrow. We get challenger job cuts in about a half an hour. After that, we get initial jobless claims at 8:30 a.m. I'm focused on continuing claims, given the fact that they've really climbed recently. There is signs of weakness that some people are pointing to that really is just sheer out-and-out weakness. There is a focus also on the consumer financial health. This ties directly into that. We get the third quarter household change in net worth. That's coming at noon. Remember that the net worth was at an all-time high at the last reading that came out in September. Consumer credit at 3 p.m. How much of the joy, the shopping frenzy, the retail therapy of Americans is being fueled with your Amex? That is something that we will get a sense of in earnings today in terms of what people are buying. Lululemon, Vail Resorts, Restoration Hardware, Broadcom, some of the things that are going to be reporting earnings, companies that are going to be reporting earnings after the bell
Have you noticed how Lisa's market checks, Tom, have become deeply personal?
They have.
Have you noticed that?
This is towards the end of the year.
Pick the
Has
names that
something to
Lisa's
do.
interested in.
Hold on. No, there were other names, but not
Price
those were really
up,
the main
yield
names.
down, deeply personal.
I'm just connected to the American consumer.
Yeah, okay.
There's
all right.
there's two American
You're not buying
consumers
that?
out there. There's a flat on their back American consumer, and there's this boom economy.
Lisa's
we're
the
in.
one skewing the consumer confidence numbers.
She is.
It's dreadful out there. Anne Milady joins us now, head of equity at Allspring Global Investments. Anne, good morning to you.
Good morning.
Let's talk about equities and let's talk about earnings. Your line right here, look for where earnings growth can be more easily achieved. Where'd you go for that?
I think healthcare is definitely a place, but I would say there's other places in defensives as well. Healthcare just screams to me the place to be when you look at where earnings growth could come in 2024.
You are too modest. Folks, let's get to the chase. Anne Milady, delivering with the Allspring Opportunity Fund, is in the 95th percentile 1 year, the 90th percentile 5 year. It's like if the Brewers won the World Series. You're killing it. And you're killing it with Magnificent Seven, big, ugly growth stocks. Does that story change next year?
Well, Tom, I can't take credit for managing that fund anymore. I used to.
You used to,
yeah,
but still,
used to.
you know.
But I would say, look, across the board, our portfolio managers have not been overweight that Mag 7. They haven't ignored it, but those stocks have, for fundamental reasons, done fairly well this year. The earnings growth for those names, 2023 has been 30%. Earnings growth across the rest of the S&P, 0, or worse in some cases. And so, but as we look to 2024, can those large cap names repeat that same growth?
Can they? That's the that's the money question.
I think the comps on that really, really, really tough. But if you look at healthcare, where earnings growth has been sanguine, and you've seen multiple compression across the defensive sector of more than 11% relative to those other names, that area screams good risk reward to me.
It's a huge money question here. Lisa, John, and I, the narratives we're getting. What was the BNP Paribas?
4,300.
4,300. You guys are in the 90th percentile doing what everybody's talking about, where you're doing it, which is own Apple, own Amazon. You're telling me to get off that gravy train?
I think you take some dollars off that gravy train and you start to reallocate them into places that maybe the market just doesn't care about right now. One of the things I've always learned in my career, you got to go there before the crowd does. You want to be there before everybody else does. Or, the first 25% is probably maybe the most important. You don't want to sell too early, but Tom, like the fundamentals really are much better in some of these other areas than people really do see.
How much of the healthcare bet is on Ozempic and weight loss drugs?
Lisa, it's like that's been the multiple compression we've seen in the area, a good part of it. And you know, whenever you see the baby being thrown out with the bathwater, and we're definitely seeing that across the board, all healthcare, it feels like, has been discounted because what these drugs are going to do to the system. Again, it's going to do some good probably to the system long term, but not all med devices, not all healthcare companies in general will be hurt from this. There will be some that benefit from it. And again, is it going to really hurt near term? 2024 earnings appear to be really strong. Multiple compression has been really, really, you know, discounted. So
can we dig a little bit deeper here? What companies have been thrown out? The idea of illnesses that will get remedied that you're saying, just pump the brakes. People aren't going to necessarily get so much healthier so much quicker or more quickly.
Yeah, I mean, look, these drugs, you know, from what we know, definitely help diabetes. That's what they were designed for in the first place. And so all the other illnesses and comorbidities that go along with that, certainly it is challenging those, you know, companies, the glucose monitor companies, and then all the other things. And I can't talk about specific companies, Lisa, but those are the companies that have been heavily discounted. But all the companies across the healthcare sector have been impacted. And it's just, it actually will drive growth in some other areas of the companies. And when I'm talking to our portfolio managers, they're excited about that. Although not ignoring the market's probably not wrong about the direction of these drugs long term. And I think that's kind of the, where do you get it right? You don't ignore the long term.
Let's go through it piece by piece. So S&P 500, modest upside, sector, healthcare. Let's talk about size. Small caps bottomed at the end of October. We've had a double-digit percentage point move off that bottom, north of 10%. What now? What do you like about small caps?
I think you have to dig deep in small caps. And now's not the time to own the index. I would say even in 24, you don't want to own the index. And when you see the pop that you get, I mean, really, small caps are acting like a leverage play on the treasury market right now, right?
Is that just the regional banks that are in that index?
Yeah, they are. And I think that's really what you're seeing right now. I would suggest that investors need to dig a little bit deeper. And when you go into the numbers and the data, they're not all levered bets to the treasury market. There are high-quality small and mid-cap companies that have free cash, that have margins above 20%. Those companies are trading at 25% discounts to their large-cap peers. That's too great of a discount. And to me, those are two signs that do signify quality. They don't have terrible balance sheets.
Let's talk about those levered bets against the treasury market. We've had a 20% move off the low on the KBW Banking Index from the end of October. It's just a monster move. Now, am I trading banks for higher yields or lower yields? I'm trying to work it out, but based on this performance, I think it's the opposite to what we were told for many, many years.
I think still our managers are overall underweight the banks, and it's because they like to focus on the fundamentals and not play just this swing in yields. And although the fundamentals are good for some of the regional banks, it's not great across the board. And again, depending on the macro conditions, things can swing pretty heavily for the banks. So again, it's some of the other defensive areas that I like a little bit more here.
Including healthcare. And thank you, Anne Meletti there, of Allspring Global Investments. This rally, Bramo, in the banks has been absolutely unbelievable, in line with the rally we've seen in treasuries.
Which does raise a question. Is this just the idea that yields are stabilizing, or is it something else that sort of has a counter narrative to what traditionally has been higher costs in terms of the borrowing costs tend to do better for these banks? I mean, honestly, everything's been turned on its head this year.
The whole year has been upside down in many, many ways. If you are just joining us, welcome to the program. The scores look like this on the S&P 500. Equity futures going absolutely nowhere. We are 1 hour and 18 minutes away from jobless claims. We are negative 0.01%. Some price action. Here it is in the bond market. Yields up 5 basis points, 415.52. Look out for claims to see if we get any movement there. Productivity was the story yesterday, Tom. You missed that one. Mike McKee did a tremendous job covering it for us. Productivity higher, unit labor costs lower. It's kind of the perfect mix for this Federal Reserve at the moment.
And if we sustain productivity is the money question, and that again goes into the labor component of productivity. It's underplayed. It's been underplayed for 20 years, frankly. But John, you know, and I go back to the polarity, 6-8 weeks ago of Goldman Sachs Sachs versus Morgan Stanley, and the one distinction there is what does the labor market do? And that's why the next 25 hours are so important.
Bit of costing pushback over at Goldman today. He's right to highlight this, and I mentioned it a little bit earlier. We'll catch up with Liz Young on the contradictions in the equity market. The cyclicals are starting to look for better economic growth potentially, Lisa, and at the same time we're pricing in this massive amount of rate cuts into next year. We're just trying to reconcile some of those forces.
It again reminds me of the beginning of 2023 heading in when people were saying, well, you got to trade the recovery because we're going to get a recession and you don't want to get in too late. So it's kind of looking for what happens after the downturn that you're expecting.
But haven't had yet.
But haven't had yet.
And we kept asking, do you want to trade the recovery to the recession we haven't had yet?
They would say yes.
Yes.
Yes, absolutely.
And we still haven't had the recession
exactly.
for what it's worth. David Bailey's going to join us shortly of Citi Global Wealth. His outlook for 2024 just around the corner in the next hour. Looking forward to that. From New York City this morning, good morning.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labor market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, Friday on Bloomberg Television and Radio.
Do you think there is any Democrat who could defeat Donald Trump other than you?
Probably 50 of them.
You do believe that there are?
I'm not the only one to defeat him, but I will defeat him.
Who else do you think could defeat Donald Trump as the president?
President Biden answering a reporter's question about the 2024 presidential race a day after he said he would probably not have run for re-election if Trump wasn't running. And then, Tom, we had this clean-up in our 2024. And I think we might have just about cleaned that up. It will be interesting to see if the former president is not the candidate. Looks like he will be, but if he's not, where that would leave the president after the comments he's just made in the last couple of days.
And the comments that Terry Haynes gave us in the last hour, if you dovetail Haynes's decades of perspective on what Republicans in name only, what do they do if the former president is the candidate? all of a sudden this is a bigger mystery than it was 6 weeks ago, 8 weeks ago.
There's also this big mystery within the Democratic Party, and I was looking at a Wall Street Journal poll, and as well as a Gallup poll that was conducted throughout most of November, that showed that 63% of Democrats disapprove of Israel's military actions in Gaza, 67% disapprove who are younger than 35, and 64% of people of color. So this really raises this question, A, does this matter? Is this going to fade by next year, late next year? Or is this really pointing to a division within the Democratic Party that's going to make it really tough for Biden in an election?
A division in Washington on two big wars.
Yeah.
And I think this is so important, Tom. You expect there to be division in Washington, and we've talked about this a few times in the last week. It's healthy. You almost desire it. But on key issues, you need some policy continuity, don't you? And we've got two wars taking place right now that may or may not get support, dependent on who is in that White House. You've got Republicans who are questioning aid going to Ukraine, and you've got Democrats questioning aid that is going to Israel. And, Tom, that's going to really complicate things for the leaders of those respective countries, engaging in war on the ground going into next year.
Then we could talk to Jeff Fitzpatrick about this, but just one more thought. We're in a gerontocracy, and at the same time, another G, there's a generational shift going on. The polarity there within the wars of the Eastern Mediterranean is absolutely stunning.
And please, Lisa brought up the polls. You can see that so clearly in the polls for the president from his own party.
Yeah, and it really goes back to the debates we're having here in surveillance. To get a brief now on this, Jack Fitzpatrick joins us, the Bloomberg government, and particularly encyclopedic knowledge of Capitol Hill. You know, Jack, I look at these debates as well, and I've got to assume senators and members of the House of Representatives are riveted by the same debates. Give us the divide between the gerontocracy that we perceive we're living in versus the generational divide as we go to our various and sundry elections?
It's a complex line to draw if you're making a distinction, especially if you try to pick an issue. As you guys mentioned, generationally, there's some movement as it relates to support for Israel, younger voters expressing in polls a lot of concern about their actions in Gaza. Then again, if you try to apply that logic to concerns about a gerontocracy, the one Democrat who's really put up a fight and the one Democrat who voted against his party yesterday on a procedural vote was Bernie Sanders, who put out a statement saying he's not supportive of this foreign aid negotiation that they're having over concerns of Israel's actions in Gaza. So it is the concerns over the age of our leaders are a major issue in politics in the presidential race and going down the ballot in Congress, but it's also a little bit difficult to apply how that to project that onto certain policy debates, and one of the more confusing ones lately is the conversation about this Ukraine, Israel, and other foreign aid package on Capitol Hill.
Let's go there. Let's understand exactly what's holding up the Ukraine funding. We did hear about Bernie Sanders, who you mentioned, wanted to see Israel funding put in there, and that was one of the reasons why he opposed that. Other people have pointed to the fact that you have seen increased calls for border security, and Biden has accused Republicans of putting certain measures in the bill that he did not want to pass. What are those measures? What are the main sticking points?
So the Republicans want anything that includes funding for Ukraine to also include a border measure that has they want to get at asylum restrictions, essentially. They do not just want border security funding. They want a reduction in the availability of asylum claims or cases in which people have to wait in a different country as their claim is being adjudicated. The concern among a lot of Republicans is that if Democrats agree to lower the basic numbers on asylum claims and people allowed to come across the border, that parole will be used in some circumstances to circumvent that. So there's a very tricky debate going on in which they discuss not only the availability of asylum claims, but any policies that could subvert an agreement on the basic basic numbers of asylum claims. That is very complicated and politically tricky. So unless they get an agreement on that, Ukraine funding in particular is held up.
If anyone's eyes are glazing over listening to this, they'll glaze over even more knowing that nothing will actually get done because there's so much polarity between both parties within each party. We talked just recently about the Democratic polarities, but within the Republican Party, we can't even solidify around leadership. Kevin McCarthy, the former House Speaker, deciding to step down. How much does that complicate the Republicans' effort to really push through some of these initiatives?
To be honest, Kevin McCarthy leaving at this point does not complicate it. The House Republican Conference really chose to go in a different direction. There are plenty of questions about the direction they're going in under the new speaker, Mike Johnson, who is a bit of an unknown coming into it. His relationship with the Conservative Freedom Caucus and how he approaches not only foreign aid, which is something there's been a lot of ideological movement among Republicans, but also government funding deadlines in January and February. That's a big X factor, but at this point it is very clear that the House Republican Conference was ready to move on from Kevin McCarthy. It wasn't clear what role he was going to play anymore. They've got a dwindling majority, but the things they're negotiating need a lot of Democratic votes because they need to get through the Senate. So it was, I guess, a touchstone moment to see the former speaker decide to leave Congress, but it doesn't necessarily change what we know and don't know about the direction of Republicans in Congress.
Jack, just quickly, you mentioned those funding deadlines. Remind us of those dates in early 2024.
January 19th for 4 of the 12 bills, February 2nd for 8. The first 4 are supposed to be the easier ones. February 2nd would be a tough deadline, including the Department of Defense.
19th and 2nd. Jack, appreciate it. Thank you, sir. Jack Fitzpatrick there, down in Washington, D.C. 19th and 2nd, TK. I think we're going to have a big fight next year over some big issues very early on.
The consensus, well, not the consensus, if you talk to Wendy Schiller or Brown, she'd tell you that fiscal issues drift away as you get to an election. Will this time be different? Just simple, does the debt and the deficit actually matter at the levels we're at?
The fiscal issues are part of the campaigning in some ways, Lisa. I imagine they will be going into November.
Yeah, but how much do people actually care, right? This is sort of the difference between the parlor game that we play now and then what actually drives voters to the booth. And often it is something else, whether it's inflation, and maybe they'll feel that, maybe they won't as a result of the deficit. But then it's things like abortion, it's things like border security, it's things like education, it's other issues.
Agreed. Border security is going to be massive, particularly as we push and push for more foreign aid.
That's not fiscal debt. Border
Ukraine,
security is the culture wars. It's
Israel,
a huge deal. I totally agree with you, and it's particularly key in the swing states. It's more than just a national issue. It's a swing state issue.
More politics a little bit later on in the program. On the market, Megan Robson of BNP Paribas on credit coming up very shortly. Look out for that conversation. That's just around the corner. The price action looks like this on the S&P 500. Here's the cheat guide to this morning. There's not much price action. The equity market going absolutely nowhere. Yields are higher by 5 or 6 basis points on a 10-year, 4.1571, 4.1% on a US 10-year, and crude in the 60s. Should you be concerned about crude in the 60s? Paul Sankey of Sankey Research saying this is not about demand. This is about booming supply in the United States of America. From New York City this morning, good morning.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For once, a little bit snoozy out there in the equity market, at least, going absolutely nowhere on the S&P 500. We look like this, positive by 0.01%, the NASDAQ positive by 0.2%. There is a mover out there. I need to talk about this one, Bramo, a challenger to NVIDIA. AMD, at least that's what they'd like to be.
So they came out with the MI300X, which I'm sure everyone is incredibly familiar with. Basically, they're calling it the most advanced AI accelerated. This, to me, was the most interesting thing. Lisa Su came on Bloomberg Television and yesterday was just talking in general as AMD released this new product and said they had been predicting that the market for AI chips would reach $150 billion by 2027. She said it's really clear that the demand is just growing much, much faster and now projects $400 billion in the same time frame. So more than doubling it, and that gives you a sense that even the reality is outstripping some of the hopes and dreams around AI.
This is going to be sequential. Look for Microsoft to come out with chippiness as well. Chips are like French fries.
Nice. Okay,
it's like French fries, but they're chips.
Okay, thanks for explaining that, Tom. Is that what they're in the business of doing?
Yes.
Like NVIDIA? They make good chips.
They make good
chips. Good chips. Okay. AMD's up 80% year to date. That's a good year, right?
Well,
NVIDIA's up 211% this year.
Exactly. So they're going to try to sort of cling on to some of that. Can they compete in a real sense at a time with such incredible growth? Honestly, this has been a story that has continued to surprise to the upside despite all the skepticism from people like myself.
Let's turn to the bond market. Get some more Bramo skepticism for you. 2-year, 10-year, 30-year, 10-year, 4, 15, 14. Yields a little bit higher on a 10-year maturity today by 5 basis points. These are kind of normal moves these days. Anything from 5 to 10 can happen on nothing. But there is something out there, and it's Japan. Lisa, it's the BOJ and a signal that maybe they make a move before the end of the year. Dollar-yen gapping lower to 145. We're lower by 1.4% on that currency pair. That is a stronger Japanese yen.
I was surprised that yields were not higher in the U.S. because what you really heard from the Bank of Japan overnight was really signaling that maybe this is going to be unsustainable to have negative rate policies. And then you had one of the BOJ officials coming out and saying, actually, maybe it'll be a good thing if we abandon it. It's going to mean this sort of virtuous cycle of wage gains and prices. And this is all basically saying we're done. So here's the question. Why isn't the move bigger? And Kathy Jones said, I don't know. She was asking herself the same question. Is this just that the narrative is moving in the opposite direction?
Well, we're pricing in cuts.
Exactly.
Big cuts at the Federal Reserve and the ECB and the BOJ, potentially Tom hiking before year end.
It's a busted theory, but the thing I do, it's so easy for us to watch currency pairs here, euro yen and dollar yen, and what you really got to watch is, as a benchmark, the 10-year yield. I'll let somebody in Japan give me a better maturity there. But, you're at the 0.75 positive, and given their inflation regime, that flat out doesn't work. They've either got to bring the inflation down, or, remember, they wanted to reflate, or they got to get that 10-year yield up.
I'd follow dollar yen because, as we've said a million times, JGB, I was going to say market, JGB is not.
It's not a market.
It's sort of like
not a true market. Dead on. Yeah, absolutely.
It's been a frustration. I'll finish on crude. Quick update for you. Dropped into the 60s yesterday. We stay there briefly. got our head above water again into the 70s, but back down to about 69.84. Positive on the day by 0.6%. Let's get you some top stories. Under surveillance this morning, former UN Ambassador Nikki Haley looking to cement her claim as the GOP alternative to Donald Trump. 4 candidates taking the stage last night without the former president. Haley taking criticism for her support from Wall Street, while Chris Christie was the only one to directly attack the overwhelming frontrunner. The first contest is less than 6 weeks away in Iowa, and you wonder, of those 4, who is left, Lisa, in 6 weeks' time?
A lot of people are saying it's really becoming a two-way race now between Nikki Haley as well as Ron DeSantis, and Nikki Haley is edging out. I loved her line to Ron DeSantis when he was slamming her about Wall Street donors, and she said, "You're just jealous." And that was she had a bunch of zingers that she was quite prepared for. Thanks, fellas, for all the attention. But there is a real question of whether 15% of the vote in polls can really get her to be the nominee.
She was sharp last night.
She was.
That's for sure. Let's turn to this story. Elon Musk, SpaceX, looking to sell insider shares, putting the company's value of at least $175 billion US. According to Bloomberg's reporting, shares would start at $95. The market cap would make SpaceX one of the top 75 companies in the world, alongside names like T-Mobile and Nike, both valued at just under $180 billion. Whatever you think about the man, he's polarizing, but wow, TK, does he have to build another phenomenal company with a huge, potentially huge market cap.
And what's fascinating here, and this is the completely non-aeronautical, is the basic idea of rich guys doing this. And he seems to have had a much greater impact than Mr. Bezos and Mr. Branson. I mean, you look at the 3 projects, and it's like you can have an opinion about this one or an opinion about that one, but he and his team are like grinding this out day by day through aerospace failure, which is what normally happens.
Should we talk about Mr. Diamond and Senator Warren?
Please.
Rumor has it that maybe they're exchanging Christmas cards, Tom, this year. It's a big change. Executive.
I teared up. I mean, my eyes were misty-eyed.
Pushing back against higher capital requirements in front of the Senate Banking Committee yesterday. But JP Morgan CEO Jamie Dimon and Democratic Senator Elizabeth Warren finding common ground on another matter.
I've always been deeply opposed to crypto, Bitcoin, etc. You pointed out the only true use case for it is criminals, drug traffickers, anti-money laundering, tax avoidance, and that is a use case. If I was the government, I'd close it down.
Today's terrorists have a new way to get around the Bank Secrecy Act: cryptocurrency. I am not usually holding hands with the CEOs of multi-billion-dollar banks, but this is a matter of national security.
So you are today, Tom. It's a matter of national security. To hear Senator Warren there and Jamie Dimon almost holding hands and singing "Kumbaya," kill Bitcoin.
And both reading Ken Rogoff and The Curse of Cash. Everybody knows my opinion on this. Jamie Dimon wasn't talking to Elizabeth Warren. He was talking to this chairman of the Securities and Exchange Commission and to his good friend over at BlackRock, Lawrence Fink, who want to do ETFs on crypto. I didn't hear there that JP Morgan's sliding into ETFs for your retirement account.
This is just going to fuel more rumors. Is Jamie running? Is he going to try to get in? Is this going to be his popular outreach to Senator Warren to get support?
This is how you win elections?
This is how you win elections.
I don't think so.
Bold proclamations and then come out. I don't know. I mean, honestly, he's been one to been taking some of the news headlines in ways that people suggest maybe he wants a government role.
It's a shame because this was a really important hearing and we're all talking about the wrong thing. It's never really about cryptocurrency. This was about money, Tom, shifting to private markets. Should have been about higher capital requirements. It was about that. The bulk of it was. And yet here we are talking about crypto and not the higher capital requirements that these banks are potentially going to face, Tom, which could mean compromise their ability to finance the economy and make money in the way they'd like to.
I think that's very true. What I would say is this conversation we're having now, I thought we were going to have the end of last year or the end of 2 years ago. It's taken a while to get to this point, particularly on crypto. Look to Bloomberg and our work on crypto. We think it's been path-breaking and out front on Binance and the rest. Right now, too short a visit with Megan Robson, the head of U.S. credit strategy at BNP Paribas, with a really nuanced pro note on the dynamics of fixed income forward. Translated to mere mortals like me, what's the movable part of fixed income you're focused on for next year?
So our credit outlook, we think the spread range can hold next year.
But within that, we do think credit spreads will drift wider. So
what does that mean for our viewers and listeners?
For our viewers and listeners, it means total return still attractive in credit. So you can get a mid-single digit positive total return. It means excess returns, low single digits with spreads moving wider. I think the key way to position is for decompression. So we think higher quality is positioned to outperform in 2024 because we still do expect that downside risks are in place.
So this really gets to the heart of the question. At what point is a no landing a bearish scenario? At what point are rates staying higher for longer, something that hurts some of the more vulnerable companies in an outsized way? Is that your base case, that if we do get rates that stay higher for longer because we're not landing and we do have a robust growth, that you're going to see defaults tick up as companies face off with the maturity wall?
Lisa, it is. We expect that we will see defaults tick higher. I think an important point is that we're in this pause, assuming that we had the last rate hike in July and we have rate cuts next year. Credit tends to perform very well in the first half of the pause, and that's exactly what we've seen. IG credit has made new tights. We expect credit will get more fundamentally sensitive as we move closer to rate cuts. So as we approach that, if rates are high for longer, which we expect, we will see some carnage and we will see some issues for issuers that still have to refinance.
How complicated has your job gotten given the bulk of debt that's moved to the private sector? I mean, we've been talking about the banking hearings. We've been talking about what Apollo is saying, the debanking, or maybe not, depending on who you are and how you want to position it. Does it make it more difficult to understand the financing runway of some of the companies you cover?
Private credit has definitely been a source of capital for some of our issuers, and we've seen some public issuers be able to access refinancing and capital, but it's mostly still been higher quality. I think a lot of our lower quality issuers, private credit is still very selective, and we haven't seen them be able to access that market. But the data, as you know, on private credit markets is not nearly as robust in public, so it's difficult to track the trends there. We do know that debt growth has dwarfed the public markets, and so we do expect there will be problems in that sector as well.
You take this and distill it down to what people like with retirement plans think. I mentioned earlier Athene of Apollo Global Management. They have a 7-year, some form of multi-year annuity yielding a stunning 5.70%. Where are those kind of yields going to be if I wait a year or I wait 6 months?
So at BNP, we are forecasting a bull steepener of the Treasury curve. We think long end yields will be stickier. So next year, end of 2024,
I'm going to still have the opportunity to take a high 5%.
So we're calling we're calling for 4% on the 10-year Treasury, whereas we are calling for a more substantial rally to the rate-sensitive, policy-sensitive parts of the market. So it does mean if you're in the 5 to 10-year part of IG, you can.
John, I think this is the absolute heart of the matter: is what happens to the money market fund stuff? What happens to the annuity stuff if the yield doesn't come down, as Megan suggested?
I was just going through some of the FX calls at BNP Paribas. Euro dollar 115, dollar yen Tom down to 135. That's the call from the team at BNP on the FX side of things. Where are we now? Break of 145 early this morning.
Yeah.
Looking for some big moves, Lisa, potentially in foreign exchange.
Yeah, particularly given the fact that everyone's expecting the Bank of Japan to eliminate yield curve control, maybe. Does that sort of shatter your world at all, Megan?
Yeah, so we are expecting monetary policy divergence between the Fed and the BOJ. So the Fed cutting next year, we do think the Fed will, or the BOJ will hike. As that happens, hedging costs for Asia domiciled investors will start to come down. That's been a huge drag on demand from the Asia investor base for IG. So we do think that we could see hedged buying return to the market. And for investment grade, that's been an important source for the 5 to 10 year part of the curve.
The monetary policy cycle has been so synchronized between the ECB and the Federal Reserve, and yet the BOJ just seemingly going in the other direction. It's amazing.
And they are doing that intentionally this time around. They were waiting for this so that they could do it without too much disruption.
They never saw this inflation, Tom, as a problem. It was a once-in-a-generation opportunity to reset something they've been trying to reset for 20 plus years.
It's just a busted theory. We need to reflate. Let's come up with a theory. End of discussion.
If you are just joining us, welcome. Welcome to the program. Equity futures on the S&P 500, just about positive by 0.02%. Yields a little bit higher by 5 basis points, 415.71. Megan, if I can, I want to squeeze in another question. Just on the 10-year, $395 is the year-end price target. You said 4 there and thereabouts for next year for you and the team. That's not much downside from here. Why is that? Where does that come from?
So we still think the term premium story has legs in that there will be a substantial amount of treasury supply, which should keep the long end more sticky in terms of where the rate ends. So for credit means carry will still look attractive on the long end. We do think that the technicals will still be supportive there. Issuers, of course, do not want to borrow at those types of levels. So it does mean that there's a crowding of supply in the front end of the curve.
Interesting. The distinction, Lisa, again, between the front end and the long end. Those calls out there going into next year.
The bull steepening, this idea that you can see
time.
rate cuts, but longer term, there still are these issues of the deficit, of the Bank of Japan, and just structurally better growth. Is it a good thing, a bad thing? You know, again, we can get everyone's calls, and then to extrapolate out to the market is another situation.
All we can do right now is get everyone's calls. Yes. That was the outlook from BNP for 2024. Megan, thank you.
Thanks for having
Megan
me.
Robson there. Coming up, 8:30 in the next hour, just after jobless claims, Tiffany Wilding of PIMCO. That's just around the corner. Just around the corner as well, we're going to talk about AMD with Mandeep Singh. Look out for that conversation up next. Equity futures right now on the S&P positive by not even 0.1% on the S&P 500. In the bond market, yields higher across the curve. On a 10-year, up 5 basis points, 4.16%. From New York, this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We can all see what's changed, right? People need more compute. They're installing more. The numbers for this year are probably closer to 45 billion. And when we talk to customers, when I spend time with our partners, and what they tell us is the technology requires more compute. And so we now believe the total market for this, it's upwards of 400 billion in 2027. It's huge.
As we say in New York, Tom, huge.
Huge.
Huge. AMD CEO Lisa Su with an eye-popping forecast on the size of the AI chip industry in a conversation yesterday with Bloomberg's Ed Ludlow. That's a big number. That's a really big number.
They're big numbers, and it's the beginning of a competition that's been widely anticipated. And what's interesting, John, is the timeline here. And what the adults are telling us is it's going to come on faster than we would expect in a normal cycle because of the frenzy to pick up on the actual doing of AI, not the fancy talk.
NVIDIA won't be the only winner if AMD has their own way.
Microsoft.
I guess that's the message.
I'm watching Microsoft and Azure, but the answer is, it's a chip war.
Well, it's a chip war, and yet people can't get it quickly enough, so there seems to be room for everyone. I want to have a better understanding of what the barrier to entry is in a field that a lot of people say is very complicated to figure out how to make these chips, where to get the labor to make them,
Right.
and then supplying with all of the potential natural resources.
Let's get a perspective on this right now, and he's truly expert. Mandeep Singh, Senior Technology Analyst, Senior Vice President Substrate for Bloomberg Intelligence. Mandeep, I have the clearest memories in the late 70s of somebody, a couple zip codes over, bringing in a big hunk of silicon and saying, we're going to make wafers out of that. We are beyond that. How hard is this task that NVIDIA, AMD, Microsoft, and others are doing from an engineering standpoint? How challenging is this moment?
Look, I mean, what GPUs have shown is, you can do a large amount of parallel processing. And I think the manufacturing side is still concentrated with TSMC. So that decoupling has actually accelerated chip design in some way, which is why we are seeing this accelerator cycle. I mean, 10 years back, you can't even imagine going past CPUs, and that's what we are seeing now with accelerators. There's innovation in chip design, and that's going to continue.
I mean, I remember, Mandeep, germanium. I had to pronounce it. I still can't spell it. I mean, that was one of the revolutions 30, 40 years ago. Let's go now. What is the distinction, the variability, the differences between NVIDIA, AMD, and, say, Microsoft's next product?
Yeah, so when you think about, Intel and AMD, they were standardized on x86 architecture. NVIDIA is entirely on ARM. And that, to me, is the big difference still, because AMD was always built around x86, can they make that pivot to ARM? Because we know ARM architecture is better for power consumption. And even though, Lisa Su talked about that expansion of TAM, it's in some way going to cannibalize their CPU install base. And if they're pivoting to ARM-based accelerators, I think that's an interesting choice given the history that AMD has with x86. So that's one consideration. The other is all their customers are concentrated. It's the hyperscale cloud vendors. And when your customers become your competitors, that's always a challenge. And that's always hanging on your head for all these companies, whether it's NVIDIA, AMD, or Intel. The fact that Microsoft, Google, and Amazon want to design their own chip instead of paying, $1 billion in CapEx to all these chip vendors. It's also something to look out for.
Which raises the question of barrier to entry, Mandeep. In other words, how difficult would it be for Microsoft, Google, Amazon to create their own hyper chip that can fuel their cloud offerings? How much is that looking like a harder hurdle, which gives AMD a bigger boost and that more optimistic outlook in terms of potential sales by 2027?
I mean, look, for the cloud companies, they don't want to design each and every chip that goes into a data center. Yes, they want to control the CPU or the GPU, the main chip, because that's strategic to their cloud, but they don't want to design every chip. That's what we have seen with Apple. Apple controls its ecosystem, it designs its chips, but there are certain parts that are still coming from Broadcom and Qualcomm. And even though they want to get away with it, it's a long tail. So that's what I expect, even with data center consumption. Yes, there are certain chips that are strategic, and we know Amazon and Google didn't commit to AMD yesterday. At least their names weren't mentioned. The others have. So that just gives you a sense of, how these cloud vendors are thinking about it differently.
Mandeep, does this also really represent this question around use, right? You said that NVIDIA has a much broader use. What are some of the uses that you think could fuel some of the sales going forward, even if AMD sort of tops out with the cloud computing, they sell their chips, and then it's all about the software and not necessarily the hardware anymore?
Yeah, I think for chip companies, especially Intel and AMD, it's going to be a hard pivot to, software. So I do think, the use case is dictated by the training of foundational models. And more or less, all these foundational models are trained using the same way. It's a transformer algorithm behind the scenes. So from that perspective, there's not much difference. But what NVIDIA has going for them is their software stack, as well as the networking aspect of it. And that, I think, is hard to replicate for the likes of AMD and Intel in the near term.
I'm fascinated, Mandeep, if they compete away profits. I mean, let's assume right now they're making ginormous profits. But if you have three players, let's say you have a triopoly of AI chips, the new chips of Mandeep Singh, do they just compete away whatever profit there is?
I mean, look, I don't think any enterprise company wants to spend a lot in OPEX and CAPEX on chips. Usually the higher value, the gross margin item is your software. And right now we are seeing these chip companies show a lot of pricing power. I do think over time, as you've got more capacity and other options, that gross margin is going to come down. But for now, until the time you're supply constrained, the pricing power remains with the chip players.
Mandeep, is this a case of US dominance all over again? Do you see winners coming from anywhere else?
I think when it comes to chip design, clearly NVIDIA and the likes of hyperscalers, whether it's Amazon, Google, have an advantage. Over time, I do think, there will be a few players in China that will try to design their own chips, and they're all going to TSMC. Remember, no one is manufacturing it. Manufacturing is that fixed asset that, that depreciates very quickly. So that's a good thing, but I do expect competition from Asia over time.
It's a good thing for now. It highly depends on the geopolitics of the future. Mandeep, thank you, sir. Mandeep Singh there of Bloomberg Intelligence. You said Chip Wars earlier. Chris Miller, great book. You started reading that yet?
I haven't read it, but it's getting
fantastic.
reviews.
Oh,
yeah.
Read that over Christmas, Tom.
reviews.
That's a fantastic
I'm reading
piece of
Satya
work.
Nadella's bio. Fascinating, his personal story. And I'm reading the woman that just won, Amy Edmondson, I believe, just won the FT Book of the Year award. I'm reading her book before the one that won the award on leadership and on using that fear is not a good thing.
Psychology and Money is the book I'm into right now. Morgan Housel, that is fantastic.
Yeah. I mean,
I'm going to lend that to Bramo when I'm done.
I'm trying to generate a leadership gauze like the joy we have on this set.
Okay. What's your book of the year? Have you selected one yet?
My book of the year is Robert D. Kaplan. This was before the war in the Eastern Mediterranean.
I swear it's Kaplan every year.
It's been Kaplan 2 years.
Okay.
This is the second
Same
time.
book?
No.
New book?
No, I used to do that. But,
Just recycle
it's the
last
loom,
year.
a loom of time, and what it is about is Morocco to the stands, out to Afghanistan, and the others. And I got lucky in that it was so clearly my book of the year, and then they gave me a war in the Eastern Mediterranean, which really makes it trenchant.
So aside from that, just going back to the chips, because I was kind of thinking about that, not to flip gears too much.
Back to the chips or back to the French fries?
I could weigh in on books, but the reality
I missed the FT
is,
Book of the Year. I didn't know that had been released.
A couple days ago.
the reality is, I have a stack of books that I pick up and I read the first chapter and then I put down, and then I have a million other things. And I'm not going to lie, I just don't get through them these days with everything else, and so I end up reading New Yorker articles instead and counting that as sort of my book
accused
reading.
LeBron James of doing? Just reading the first page. Just reading the first page. You ever seen that?
I mean, I
It's just
relate,
pictures
I
of
get it.
LeBron reading the first page of a book, and they've asked him about the book sometimes.
It's brutal.
You don't get much detail.
Imagine not, except for the first page.
Page one.
Yeah, exactly.
Riveting stuff.
Where are we in
And then
10 years
last
on
page.
this? When we get
What I do.
When we get Mandeep Singh's
Reddit.
chips and all this AI stuff, do we stop reading?
We just plant a
Where are
chip
we
in
in
our
10
brain.
years?
Just going to
I can't
retire,
get the
Tom.
kids to read. Can you get the kids to read? They don't read. I mean, they read for school because they get in the timeout chair. If they don't,
Like
other
read,
than that,
read for fun.
they don't read for fun.
Okay.
It's a different kind of reading. There's text in the TikTok videos.
Well,
That is
yeah.
a different kind of reading, Lisa. That's a very low bar. Coming up next
These
on
are
this
serious
program,
questions.
David Balin unveiling Citi Global Wealth's 2024 outlook. That drops in 4 minutes' time. Futures turning positive by 0.1% on the S&P. From New York, this is Bloomberg.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. but it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The labor force is expanding very rapidly.
I think there is still some underlying strength in the labor market.
The jobs market now is coming into question in terms of how resilient it really is.
We still have more and more evidence pointing in the direction of the labor market softening.
This is a unique cycle. That's the ultimate understatement.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television in 29 minutes. The American labor economy claims, which really frames out all of our investment belief for next year.
We're going into payrolls on Friday, tomorrow morning, Tom. I'm still looking for a pretty decent number. The data this week has been good.
Yes.
Better than good.
Shock.
Let's go through it all. The ISM, the headline number, robust. Prices paid, lower. Job openings, the lowest we've seen going back to something like March 2021.
Right.
And then yesterday, productivity up, unit labor costs lower. That's what everybody wanted to see if you were long this equity market. You had it all.
On the narrative roulette that we've got Michael Antonelli at Baird lining up out on Twitter, all the good things, all the reasons to participate in the market. And yet, John, look at the fear that's out there. I mean, the BMP readjustment near to 4,300. There's so much OMG going on. It's a toxic brew.
One person's fear, another person's dream. Let's talk about that. Yesterday, in the 60s on crude. Okay, one. Yeah. Two, 4.1% on a US 10-year yield. Framing matters. We've talked about it repeatedly so far this morning. Do you view that as the ingredients needed for this economy to reaccelerate or a sign of impending doom? Tom, take your pick.
Speaking of impending doom, we welcome Lisa Abramowitz. Lisa, I haven't mentioned this morning, but the 10-year real yield, the inflation-adjusted yield under 2%, 1.99%, that's, again, one of those vectors where all these narratives become a jumble.
I can't be a vector of gloom right now with this kind of ingredient, just because I do hear what we heard from Paul Sankey earlier, that the issue with oil prices is not a lack of demand. It is simply a real war in supply, where the U.S. is producing record amounts. There is a concern that this is too cute, that you can't get the immaculate disinflation without some shoe dropping, and we have seen signs of weakness in the labor market, and people are trying to sniff that out. That is valid, and that is the reason why I think some sort of downside surprise in the economic data could have an outsized reaction in markets.
To me, the heart of this, and it's really where my reading is most, is on China, because to Brammo, I mean, Brammo, folks, is a vector of gloom, translated as wither China, John, and to me, this is the huge mystery into Q1, is we really don't have a handle on the totalitarian political and economic experiment of China.
So in a moment, we'll get Citi Global Wealth's outlook. We've had BNP's, and BNP's sounds like this, Tom. We see equity risk being skewed to the downside in the US and balanced in Europe and China, but positive in Japan. It's the China piece of this again. We got China so wrong in 2023. The consensus got China so wrong. It's going to reopen. We were going to boom. We'd underperform here in America and outperform over in China. Turn it upside down completely the other way around.
And Lisa, to me, the other mystery here is all the cash, trillions of dollars of cash, the money market fund flow. We all know the story out there, I think, is safe to say, but that's part of this narrative, is wither cash this year.
Especially if short-term rates come down. And so all of a sudden, you're not talking about 5% anymore. You're talking about 4% or maybe 3.5% on your money market funds. Then all of a sudden, is there a gravitational force out of cash into other assets? Again, all of these unknowns. How sticky are these funds?
Gloom statistic to get the data started, John. The VIX. David Balin's looking over. He's looking for a secret.
He's looking at your Bloomberg.
Pro tip: 13.16 on the VIX.
I think David Balin's doing what every other guest who's come on this program over the last 10 years does, trying to work out the first question that Tom's going to ask, because no one's got any
I got two. It's a double barrel.
I hear it from guests all the time.
I thought he was going to ask me what the VIX was. That's where I was leaning over.
Okay. David Balin, CIO and Head of Investments at Citi Global Wealth, with us in just a moment. Let's turn to the price action. Equities on the S&P 500 shaping up as follows, TK. Positive by 0.1%. Yields up 5 basis points, 4.1552 on a US 10-year.
Audible question to Balin. You worked with John Henry years ago, the owner of the Boston Red Sox. How in God's name does John Henry let Juan Soto go to the New York Yankees and not the Boston Red Sox?
And I won't answer that question, but tell me how it is that John Henry, as a trend follower, has won 3 World Series when the Yankees have only won 1, and that's him a period of time.
Very nicely finessed.
Thank you very much.
Very good. Let's go to cash. I mentioned it to Brammo. It's in your review here, the mystery here of all this cash. And you talk about there's just too much cash out there. What do we do with our cash next year?
You've laid out, actually, an incredible introduction to what we're writing for this next year, which is called Slow Then Grow. And the idea is that you are going to see a slowing economy at the beginning of the year. A lot of the concerns that Lisa just talked about, actually could come to bear, right? Which is the economy slows down, but it does not crash. We do not have a recession. We do not have a V-shaped recovery. And because we don't have a clear signal to investors, they sit there in cash. $5.8 trillion worth of cash at this point in overnight funds. It's extraordinary. And yet, when you take a look at all the different parts of the economy, right, you take a look at the average stock in the U.S., hasn't done that well. 10 stocks have done incredibly well. Bond market's already started to move. Energy is down. You are seeing real signs that inflation is not an issue and that the Fed will hit their target of 2 to 2.5% by the end of the year. So if that's true, right, what you then need is a boost of earnings, right, in order to believe that all of this comes together. And this is where I think the story is being missed by the average investor, is that in the U.S., you're going to see ambient-like earnings up by probably 5% this year and then 8% in 2025. And that sets us up for a thing where, an opportunity where a balanced portfolio, right? You put your money in bonds and you put your money in stocks and you sit there and you're patient. And over the next 18 months, you can get yourself a 15 or 20% total return. Now you're giving me the skeptical look, Lisa, right?
I'm just interested.
Here's the interesting data point. In 1931 and in 1969, the last 2 times we had stock and bond markets down for an entire year. If you looked out just 2 years later, in each of those periods, a balanced portfolio, 60-40, was up more than 20%. And while that's not statistically significant, what's interesting is we've already had incredible negativity in the stock market and incredible negativity in the bond market this year.
Okay, and you point to Tom, but this to me is really a question of, can you bet on the grow before we get the slow?
Right. Well, the grow is already. The grow is the coming off of. It was good.
1 sec. Did you just make that up? Because that's great.
That was like a haiku.
Well, that's essentially what we're asking: is can you bet on the expansion before we get any kind of slowdown?
I love that. That's awesome.
Okay, so we have to answer the question.
No, please do.
That's okay. So let's take a look along real estate,
right, which has already been in a recession. We've had manufacturing already been in a recession. We've had parts of the parts of our economy like healthcare, right, negative earnings for the first time in 15 years this last year. Lots of these parts of our economy, 40 or 50% of our sectors, are going to be having very positive earnings relative to 2023. And then the average stock, which has gone virtually nowhere this year, has the opportunity to rise. One of the things we put into our portfolios is the most boring investment we've added, which is S&P equal weight. If 10 stocks have done well, you want to own the other 490. So I just think that this is where people have sort of missed it, is that we haven't seen the overall market rise yet. And that's what 24 is going to be about in terms of earnings.
So the double-digit percentage point gain that you think we can get next year, that's at the equal weight and not the market cap weighted index?
That's right.
Okay.
That's right. And I think that's the opportunity, is this rising earnings, because you've had large portions of the U.S. economy are coming out of a recession now. Their inventories are down. They've got to rebuild. They're not hiring. Wage costs are coming down. It's not about a landing. That's the other thing. Everyone's talking about this hard landing, soft landing. Forget about it. We're now in the situation where we're now beginning a normalization of markets back to sort of where they were like 4 years ago, pre-pandemic conditions, and we're going to be coming out of this in a grow mode.
Are banks structured well for that moment?
Have bank structure or our client structure?
No, are banks structured, as in the equities, the bank equities that have struggled so much this year off the back of high yields?
I mean, I definitely believe that the normalization of the yield curve is going to definitely change valuations for banks as a segment. I think that's more of a 12 to 18 months trade than it is a long-term opportunity. I do think that banks are very undervalued at this point.
I guess I'm trying to understand this perfect scenario and how much oil plays into it as well, given the fact that that has been one of the reasons we've seen this disinflation narrative get some legs. How much does that factor in that we're going to keep seeing suppressed valuations?
Right. So I don't think we expected oil to move down as quickly as it has, and I definitely think it's supply, like you said earlier in the program. What we have, I think, discounted is the fact that globalization is still a major disinflationary force. Import costs of goods coming into the U.S., both finished and unfinished goods, are negative 3.7% relative to last year. They are adding to the disinflation story. So between energy and import costs, you have this situation where you just don't have inflation on goods, and that, of course, translates into a better economic scenario. It seems like you're having trouble believing that that you could have a really good backdrop for markets.
No, what I find fascinating is just how much the narrative has gotten it wrong. Everyone was talking about deglobalization, how that would lead to inflation. Oil prices would be higher because their production just wasn't capable of meeting demand as all of the transition happens. And all of a sudden, workers are going to cost more to do the jobs that need to get done. And what we're seeing is all of the exact opposite. Isn't that sort of remarkable?
It is remarkable. The hiring for the last 2 years has been surprising. We've hired more people with slower GDP growth in the U.S. than in history, and now that's coming the other side. And the Saudis and OPEC wanted to keep oil prices higher, right? But they were unable to do so. They were originally willing to cut back production. So there's a lot of things where people think they can control market. And just to add one more thing, expectations in China and Europe are so low that they can't help but contribute, I think, to the growth story sometime in 2024.
This was great. You two should get a podcast. I think this is
you do that all the time here.
Podcast. Yeah, we can do another one. Why not? What should we call it? Hope and gloom. Yeah. Something like that.
Bad news, bad news.
Bad news
is bad news.
Something like that.
We just call it slow then grow, or what was the other
we
phrase?
Forget.
Okay, but it was good. It was something like
slow versus grow is awesome.
Well, that's
I've
his
got
words.
A lot of time for that.
That was the whole thing. I mean,
Love
that's
that.
the bet that we have going on here.
That's great. David, thank you. It's good to see you, and thanks for sharing your outlook with us as well.
My great pleasure.
David Belling, then, of Citi Global Wealth, looking ahead to next year. Double-digit percentage point gains, Tom, on an equal weight S&P 500 for 2024.
I think there's a lot of people lining up, and this is where I am personally, is just a continuance of where we are. There's all these narratives of we got to change this, we got to change that, we're going to shift. What if on a quarter-by-quarter basis we just see this American exceptionalism? That's not a consensus call, but that's less said.
Control room weighs in. Balin and the Bear. Balin and the Bear's kind of good. I like that. That can work. That can work.
All right, but I'm not necessarily the bear. Honestly, I was just...
this morning you're not. I agree.
And I'll just say, honestly, this is to me fascinating because all of these narratives that this time is different are being flipped on their head. And oh yeah, this time isn't that different. And that might be what's maybe coming to the fore with some of these economic projections.
We're on the same page.
Yeah.
Just a spectator here enjoying it. If you're just joining the program, welcome. It's been a good one so far. Equity futures on the S&P 500 positive by 0.1%. Yields are higher by 5 or 6 basis points. The 10-year 4.16. The attention is going to shift now to the labour market. Tomorrow morning, we get payrolls. The estimate in our survey, 186,000. The previous number, 150. Jobless claims coming up in about 18 minutes' time. 220, the estimate, against the previous number of 218. Tiffany Wild is going to join us a little bit later of PIMCO TK to weigh in on all of this at 8:30 Eastern Time.
I'm going to just editorialize here with 13 minutes to go, 17 minutes to go. John, this is the most important claims report in ages. It's weekly data, and this is a week Torsten Slok and Apollo nailed this. The linkage of these two reports is critical.
It's only important if it disappoints, right? I mean, it's only important if it comes in underwhelming or more people file for jobless claims. Otherwise, it's going to start to fuel this feeling that maybe we can get this no landing. And where are we? What economic cycle are we actually analogous to? I find this really interesting.
So help me understand. Good news is good news.
Yeah.
Bad news is good news, but super bad news is bad news.
Yeah.
Okay.
What's
super bad on payrolls? Sub 100?
Sub 100.
Sub 100.
You know,
Yeah, that would be pretty bad.
I just thought of something.
What's that?
Balin has tickets at Citi Field like no one.
Didn't know that.
We could get Citigroup. We could get tickets for the Mets at Citi Field.
They're not a very good team, though, are they?
They don't have Juan Soto.
Right, sorry.
There's heart there.
Just the Yankees made a big purchase recently, and
I know, so you're
the Mets.
I'm going to
Yeah, that's
go
true.
Matt Hornback, Morgan Stanley, Jeff Sherman, double line, all of that coming up on Bloomberg TV. Plus Liz Young of SoFi. Going to run. Bramo, I'm sorry. Go Mets.
There you go. Good job.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. All eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labour market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, Friday on Bloomberg Television and Radio.
Nikki Haley, she caves anytime the left comes after her, anytime the media comes after her.
Now you have Reid Hoffman, the person who's effectively George Soros Jr., funding lawsuits across this country against Donald Trump. We discovered this week that he is one of Nikki Haley's largest supporters.
I'll tell you this, I've known her for 12 years. This is a smart, accomplished woman. You should stop insulting her.
I love all the attention, fellas. Thank you for that.
How strange. What were there the first debate? There were 14 people on stage?
Exactly.
Something like that?
Whittled down to 4.
Down to 4. Where will we be next time, if there is a next time? From the Carolinas, Nikki Haley there in the firing line at the Republican presidential debate. Chris Christie of New Jersey to the defense. John Farrow in deep preparation for a 9 o'clock hour. Bramo and I looking at NASDAQ up 0.3%. What we're really looking at, 12 minutes from now, as I've said, this is a jobless claim, folks. This is not the usual Thursday claims.
The drumbeat to non-farm payrolls that we get tomorrow at a time where there's so many questions around how long this labor market can withstand some of the pressures. Ongoing claims, continuing claims. I'm keeping an eye on that given the recent increase.
I agree. I agree. I look at, there's 3 things here. There's the weekly data, folks, which has got a lot of noise in it. I leave that to McKee. There's your continuing claims, which I think is hugely valid this time around. And then I take a 4-week moving average of the weekly number. And I'll let Mike McKee tell me which of those is most germane, but continuing claims has a new weight here, doesn't it?
Given the fact that we're just trying to understand how difficult is it to get hired, given that quits are falling. We did get Challenger job cuts. They came out, and they were down, actually.
Yeah,
so it came out, and it was actually not. You don't really buy those?
We used to hang on it. It was like M1, M2, M3. Challenger came out, and the world stopped, I'm going to say 30, 40 years ago. I'm not sure the world's... I'll let McKee decide. I just don't know what to do with the Challenger number.
Fair enough.
It's like ADP yesterday. Except ADP moved the market yesterday, didn't it?
It tends to. A Challenger job test didn't. Honestly, a lot of questions are going to be next year as we head into the political silly season, as you would call it, how some of these conversations will evolve.
Data, a little bit of lift here because Lisa's here. We're doing bonds. 2-year yield, 4.62%. 10-year yield, 17 basis points from a 399. That gets my attention. We're down to 4.10% in the shock yesterday.
Given the fact that people are saying under 4% might signal something bad is afoot.
Right now, we're going to get to Henrietta Trace, Director of Economic Policy Research at Veda Partners. And Henrietta, on this 82nd anniversary of Pearl Harbor, thank you, Associated Press, for informing us there is one survivor left at 102 years old of the USS Arizona. What's the budget state of our U.S. Navy right now? We've got lots of material in the Red Sea and in the Eastern Mediterranean. You are expert on this. Is our Navy properly funded?
Well, it's about to not be, and indeed anything in the federal government has not been properly funded for this entire year. We've been functioning, obviously, on short-term CRs, and it looks a lot to me like we are going to go into this Christmas holiday break next Friday without any additional funding for Ukraine, any additional funding for Israel, Taiwan, the U.S.-Mexico border. Those talks have entirely broken down, and we'll be fighting over these exact budget issues come January 19th of next year. And it'll just be sort of a rolling discussion of how out of step and unprepared Congress is to take votes on long-term spending bills to shore up defense, to shore up any sector of the federal government for probably the remainder of the year.
We were speaking with Libby Cantrell of PIMCO yesterday, and she said, on a practical level, it's unclear what the market impact would be of a government shutdown after the January 19th or February 2nd dates that we know are the new deadlines. That said, there is a political ramification. Who is it worse for if we get a government shutdown, the Democrats or the Republicans?
You know, I don't think that the shutdown is necessarily something investors need to spend a lot of time on because it's so bifurcated now. It'll be about a halfway point for each one of those rolling dates. The sequester is where I get a lot more questions these days. As you know, there's $1 trillion sequester, a couple billion, $100 billion sequester that starts going into effect in April. And a lot of investors are worried about that. And I think perhaps rightly so. But I would just tell you sort of anecdotally from the Hill and speaking with staff, no one expects that any of those cuts are going to go into effect. So it's hard to have the conversation with investors and walk through the process because there's not a detailed process to avoid a shutdown or to avoid the sequester. But it is well understood on Capitol Hill that these cuts will not be going into effect, either for defense, to Tom's point, or a non-defense discretionary. They don't have the votes to let those cuts go into effect, and they have will to keep the government open, which means neither the cuts nor a shutdown is realistically likely.
Which raises,
but a shutdown looks bad for everybody.
But Henrietta, which raises this question, what is going to matter for voters next November? Is it going to be the budget? Is it going to be the deficit? Or is it going to be other issues? Inflation coming down, is that going to play into Biden's hands, or is that going to play into some of the vitriol that we keep hearing from some of his challengers?
I think there's two big things: gas prices and the momentum play that we're about to go into on the political front. The economy is obviously quite strong, remains very strong. Unemployment at 3.8%. You really don't have that same negative talking point that you had, say, during the Great Recession or in the years after. It's tough, for example, to swallow Trump saying, "I'll be a dictator on day one," just to bring gas prices down. Gas is at $2.68 where I am. I don't know if I want a dictator for that price. So you really have to question where things are going to go from here. What the polling is really telling you is that about 33% of Americans, especially those in the undecided camp, just haven't chosen a candidate yet. And so for me, watching this, I don't necessarily worry that they haven't decided. I'm more interested in when are they going to start to decide. And historical data suggests that over the next 3 months, they're going to start making decisions, and one person's going to have momentum, and I think Biden has more room to run there.
Henrietta, from your first moment on Capitol Hill as a page, which I think was 15 years ago, you have seen the cycle of retirements. To me, this time is different. How does the white marble of Capitol Hill change with the character of the retirements we're seeing by Republicans and Democrats?
I mean, I'm going to say something really unpopular, but I don't support term limits for a reason, and that is because you need experience. My old boss, my first job in D.C., said you need to go through at least 2 budget cycles before you can have any rationale to talk about D.C. like you know what you're doing. These freshman members come in, and they obviously do not know what they're doing. We do not have a way to get 218 votes in the House for most of the year on most legislation, even partisan legislation. You need seniority, you need education, and you need experience. And I think that what we're losing right now are exactly those people. And I suspect when McConnell leaves, that will be a huge vacancy that will be felt for the rest of the Senate.
Henrietta, thank you so much. You've got to run to the economics of the markets of economics, finance, and investment. Henrietta Trey's just excellent from Veda Partners on Washington. We're 6 minutes away from an exceptionally important weekly number. There's noise every week in it. But as others, including Slack of Apollo, have said, this time is different. It really is.
Given the fact that it is the day before non-farm payrolls at a time of an incredible amount of speculation and uncertainty around the labor market, this is the way that it's stacking up. 220,000 is the number of unemployment claims that are expected to cross in about 5 minutes' time. The prior month was about the same. Continuing claims expected to actually go down, close to 200, but a little bit lower in terms of 2 million coming in a little bit more. There is a question here about how to read some of the signals from the high-frequency data and when it sort of suggests that we aren't weakening all that much. Yes, it's creeping up a little bit, but not really that much based on
maybe here versus over into tomorrow's wage data being almost as important as the non-farm payrolls of 180-ish thousand.
Well, especially given the fact that that's what we keep seeing. We keep seeing that input prices are coming down, labor costs are coming in, productivity is going up. It's the perfect recipe.
Now, we've got good news for you. Tiffany Wilding and PIMCO will be with us here on a 48 hours, actually 25 hours of a jobs report. More importantly, Michael McKee has entered the building. Stay with us. Futures up fractionally. This is Bloomberg Surveillance on radio, on television.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We claim it is Bloomberg's surveillance. In moments, we'll get this important data to begin 25 hours on the American labor economy. Lisa, a little bit of lift to the market. Futures up 5.
And this comes after a couple days of sogginess, which is interesting because we've seen yields in, which typically has given a boost to risk assets, and yet hasn't translated into the same kind of boost in recent days. Bond yields, 10-year yields up about 5 basis points, call it 4 basis points at this point. Again, sort of surprising that we're seeing stability in light of actual news that could have moved markets much more.
That stability is where the survey actually comes somewhat, like in the vicinity of claims. McKee, picking himself off the floor, looks at our initial jobless claims.
Well, score one for the economists. The forecast was for 220,000. We get 220,000 for the week ending December 2nd. A little bit up from what we saw the week before. It's an increase of 1,000 from the revised level of 219,000. So almost no change there. It is a little hard to seasonally adjust during the holiday periods, but we have what we have. We did get a downward revision to continuing claims for the week prior to 1,925,000, and last week it was 1,861,000. So all those stories, the narrative that jobless claims were starting to send a signal that the economy was slowing down and the labor market was getting loose, not supported by this data.
Yeah, McKee not cooperating, folks. Markets churn here, I would put it, with a 10-year yield 4.16%. I went right to the 4-week moving average. It's, nudgy 1 week, 2 weeks, 3 weeks, flat at 220,000. What are the ramifications of a flat, unchanging statistical labor market?
Well, it would suggest over a longer period that unemployment is not going to be rising significantly. And of course, unemployment is what the Fed is using as their basic labor market barometer in terms of policy. So it would be good news in that sense. There's a question about what we get tomorrow. 3.9% is unchanged forecast for November, but there are some analysts like Bloomberg Economics who think we'll go to 4, which then possibly triggers the Somme rule, and you'll get people wringing their hands about inflation. So we'll see tomorrow, but right now, the overall grouping of numbers doesn't suggest any concern for the Fed on the labor market side.
No, quite the opposite. This is just Goldilocks again and again and again. This one, not only did you get bang in line with expectations, you also saw continuing claims go down. You see the response in equities, a little bit of a lift. Yeah, you see bond yields marginally higher. This raises this question of, are we getting the immaculate disinflation that so many people had been expecting? Is there anything in this report that suggests otherwise?
Not in this report. I mean, the idea that the immaculate disinflation is happening just keeps getting more and more evidence in its favor, but until it's over, we're not going to be, nobody is going to take that victory lap. I saw some commentary this morning that said the Fed shouldn't be taking a victory lap. Well, they're not. They're actually kind of leaning the other way because they don't want to be caught out again as they were when they were slow to respond to what was not transitory inflation.
Get out front quickly of the jobs report tomorrow at 8:30. There's the headline data. There's also the Mike McKee data beneath it. What will you look for beneath the headline data?
Well, we'll look both at unemployment, but also at average hourly earnings. They're expected to rise on a month-over-month basis, which could be affected by a number of different things. But the year-over-year numbers forecast to fall to 4%. Fed looks at 3 to 3.5% as sustainable under 2% inflation. So it's continued progress in that direction. We'll also see how many people join the labor force. That's been a big reason that unemployment has gone up. If they don't, then we may see a tighter labor market number.
Michael McKee, thank you so much. And again, here I'm looking at the real yield out from a 1.99 to 2.01, at least a higher yield structure all in all off this report.
Yeah,
not to
and
oversell it, but
maybe that's the reason why the equity pop off the back of this came in just slightly. But the 10-year yield now, 4.17%. That's it's a move.
Yeah.
Nothing really particularly shocking compared to some of the swings we've seen.
We're going to continue to look at the markets, but right now I've been out a few days, but I really want to reset here on the American economy, and there's no one better to do that than Tiffany Wilding, economist at PIMCO. Tiffany, I'm going to go beyond the labor reports. We'll circle back to that. What is your real GDP growth for 2024?
Yeah, I mean, so we think that the good news from 2023, the resilience story, the 2.5% of kind of above trend GDP growth, that's probably squarely behind us. The saying kind of goes, you can't go to heaven twice. And we think some of the factors that led to that, we're still some of these excess savings sloshing around from the pandemic and other supports, and and those kinds of things under our estimation are going away next year. And when those things go away, what you're left with is still tight monetary policy. And obviously we have a Federal Reserve that is telling us they're going to remain on hold, so those policy drags are continuing to build. So overall, we think growth probably is closer to something, stagnant. Whether it's slightly positive or slightly negative, I think is anyone's guess. But we're kind of a stagnant situation next year.
So are you basically saying that we're in heaven and that this is the Goldilocks and that you can't go there again? It's over.
Yeah, I mean, so we do think there's a lot of good news this year with the U.S. economy. There's a lot of surprising resilience in the growth numbers, of course. And some we think, the supply picture, as the Federal Reserve has also pointed out, has also helped that. But again, if you looked at 2024, you have demand, which is potentially coming down. But some of the things that added to supply, like supply chain normalizations. We have the labor force participation rate for the prime age folks that are now, it's back to pre-pandemic levels. We're just not convinced maybe that you're going to get as much on the supply side next year. Now, of course, immigration has been a story here, and that's why we've also seen, the unemployment rate rise, because some of those labor market inflows aren't getting absorbed by just a strong labor demand. But again, overall, all of those signals kind of point to us of something that's closer to more stagnant economy.
Baked into this is this assumption that you're going to have higher yields for a longer period of time. You said what we're going to be left with is just tighter financial conditions, and yet it's unclear whether that's going to be the case. There have been a lot of people calling for pretty substantial rate cuts by the Fed, by the ECB, in response to inflation coming down significantly. Do you agree with the paradigm where oil prices stay lower than they have been and keep inflecting lower because of production, because of supply? You start to see a re-engagement of global trade, forget deglobalization, and you start to get more people come into the workforce. It's basically everyone that people use. It's the opposite of the "this time is different" narrative that we heard this year.
Yeah. Well, I mean, I'm not exactly sure in terms of labor market inflows, higher participation rates for that prime age cohort. I'm not sure that that's going to continue to increase. I do think there's some potential for immigration flows to stay high in 2024. That's been a story not only in the U.S. but across the developed markets. Obviously, elevated geopolitical risks and conflicts are contributing to that as well. But overall, I guess what we would say is that the Federal Reserve has told us that they are still worried about the last mile problem on inflation. In order to really ensure that inflation's back to target, we think you do need to see some more labor market loosening.
Market is coming back here in equities, bonds, currencies, commodities, a little bit of adjustment off the claims, and we've come back in a little bit. I call it noodling as we stagger to tomorrow morning at 8:30. Tiffany, one of the great responsibilities you have is to stagger down the rows at PIMCO, tripping over the antique Monroe traders and looking at people's Bloomberg screens. And the 2-minute drill is, what is the short space going to do, the Jerome Schneider space, and what's it going to do in terms of the wall of money that's out there. That's off your remit. But your remit is, what are the economic conditions that make cash finally move? Can you come up with a scenario where cash finally moves?
Yeah, absolutely. I mean, I do think it's certainly this quote soft landing scenario, right? And I think that the fact that the Federal Reserve, as well as other central banks, have signaled that they're at the top of their cycle, along with this coinciding shock to term premiums, just made bond market valuations look really attractive. And as a result, those higher yields just didn't stay around that long, and you are starting to see cash, I think, come off the sidelines, go into the bond market. Now, I think there's a question around the equity market, riskier assets. I mean, certainly a soft landing will be helpful. But when we look at valuations, for equities, for example, we are more cautious. Equity risk premiums are still within their historical range. They're not pricing in a lot of recession risk in our view. And we don't think we're out of the water yet, or out of the woods yet. There's still a lot of uncertainty here. And we just don't know that you're paid for it going out the risk spectrum.
The quality of a lower GDP reset off of the shock of what happened in 2003, 2020, listen to me, I'm decades away, Lisa, help me here, 2023. To me, what's so important, Tiffany, is the productivity discussion of the last 90 days. Give us the PIMCO brief on the efficiencies of the American economy.
Yeah, well, I think if you look more, more broadly, there was a lot of noise around the productivity statistics during the pandemic because you had unproductive sectors that were effectively shut down. Then they reopened. And so there was kind of a mixed shift, if you will, in terms of economic output that impacted the productivity data. But if you look more broadly, it looks like it's on trend at a low level. And I would say that there is, probably good news in terms of the productivity outlook that's embedded in, AI and large language models and things like that. But if we look at research that, just kind of estimates how long it takes for those types of technologies to proliferate, obviously that time has come down, but it's not 2024. It's still likely a quote, secular horizon, so 3 to 5 year time horizon that you're really seeing the productivity gains from something like that. And the last thing I would just highlight is that, we saw PCs or the internet, it took, quite some time for us to actually see productivity gains in the 90s to come from that. So, at least from a 2024 perspective, we're not as convinced that you really start to see that in the data. But I think there's, room for encouragement on a secular time frame.
Just quickly, Tiffany, you seem to be pushing back against market expectations for rate cuts next year. Do you think that we will get rate cuts by the Fed? Do you think that they'll be in the first half? Or do you think that they're going to be squarely in the second half and not that many?
Yeah, well, I mean, look, I do think it depends. I mean, the real side of the economy, it does need to slow in our view. And it needs to slow, and you need to see a little bit more, loosening of the labor market, we think, in order for central banks to really feel confident that inflation is more sustainably at their target. And, looking at, I think there's definitely some still resilience in the economy, and we could see central banks lag, worried about that outcome. Powell has very clearly stated, that he wants to be a Volcker, and not a Burns. And so, we think they could be laggy in terms of when they start to cut. But nevertheless, obviously the market's going to price a balance of risks here, and the inflation data certainly has been good over the last couple of months.
Tiffany, thank you so much. Tiffany Wild with PIMCO. They manage bills, notes, and bonds out of Newport Beach, California. I hear it's fascinating. I mean, you mentioned this, hours earlier. 12 months ago, the narrative we had, looking back, almost, I don't think it's tragic comedic, but it's a comedy, certainly, how many people got this wrong?
And if you are just tuning in, if you were thinking that we would get losses on the heels of this kind of number, you are wrong. Yet another thing that probably is wrong, you see S&P futures reverse up now 0.2% at the session highs after that unemployment filings report really highlighted there isn't that much weakness the way people had maybe feared.
And again, I'm going to go to two Americas and the technology overlays. We mentioned to Tiffany Wilding the productivity debate. You know, I'm going to say that started Labor Day. You know, September, October. Julia Coronado led the way on that, others as well, quite frankly. But the whole idea of the productivity overlay speaks to the single elephant in the room, which is the technology distinction of America. It's not talked about enough.
Yeah, although Tiffany really pointed to the fact that this will take a while to actually be borne out. And we heard the same thing from Ann Maletti. Basically, whether it's technology for artificial intelligence or whether it's technology for weight loss drugs, how much is that really going to alter the structure as we know it currently? That's sort of one of the heated debates as people try to understand where we'll be, not only in a year, but 5 years.
Out front of tomorrow, we are thrilled to bring you from the Booth School, Chicago, one of our great financial economists. A perfect time to speak to Randall Krosner of Booth and of the Fed. Stay with us, Bloomberg Surveillance.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I think the Fed put is back.
I would argue that the Fed put is sort of back.
I think there's a risk of a hard landing if the Fed doesn't start cutting rates.
The Fed put is back.
The Fed put is coming back in the money, and it's coming back really quickly.
We'll have to see next year. That's the question of a Fed put.
Ben Laidler leading off the discussion of a Fed put back last month, and now there are many others jumping on board as we take a look at a disinflationary wave. Maybe with weakness, but we're not yet seeing it in the data. The data is today positive. We see unemployment claims come in pretty much, initial jobless claims come in pretty much on target. Yeah. You could see a little lift to S&P futures. Yields retracing from where they reached before 417. Now they're back to about 415, Tom.
Yeah, yen a little bit stronger here. We've had this jump. We covered this earlier. I don't think we need to redo it right now, but you know, there's some percolation in yen, and I would say it's central banks bouncing off other central banks is sort of my theme for the morning in the banking derby.
Before we bounce that off a former central banker, I just want to bring up a couple of names that we've been talking about throughout the morning. AMD, after coming out yesterday and saying a new chip could propel their sales of AI chips to $400 billion by 2027 from $170 billion, the previous estimate. You can see those shares up by almost 3%. Google, Alphabet, the parent company, released Gemini, the largest and most capable AI model the company has ever built. This, according to JP Morgan, those shares higher, Tom, by about 3.5%. So an AI kind of morning fueling more gains there.
I looked at Bloomberg Intelligence. Mandeep Singh and Anurag Rana really first class on all of this. There's no other way to put it.
Is the Fed put back? There's no better way to answer that question than speaking with a former Fed governor, Randy Kroszner, professor of economics at the University of Chicago, Booth School in Chicago, joining us now. Randy, do you believe in this idea that the Fed will cut rates aggressively next year simply in response to disinflation, even if it is not accompanied by weakness?
So if they've reached their goal of bringing inflation down to their 2% target, they'll be happy to bring rates down. But I don't think they're going to get to their target anytime soon.
I look, Governor Kroszner, and I know you had a recent meeting where the Booth School graduate John Studzinski and all of his work now at PIMCO as well. But what the John Studzinski world is about a global sense of we're all in this together. That's been the hallmark of his work for years. How linked now are our central banks to develop a constructive disinflationary trend?
I think that's right. I think you saw that once the Fed took off, raising rates fairly aggressively, the other major central banks in the world did the same, so that they kind of played from the same playbook because they were experiencing inflation in a similar way, which suggested that at least part of the inflation wasn't just due to what central banks were doing, but was also doing to some of these broader global supply chain factors. And we've seen inflation come down. We've seen them move down together. But the Fed is really the big player, and so it tends to be that other central banks will follow what the Fed is doing. But of course, there's some discussion across the central banks. But the Fed's got to do what it's got to do for the U.S. economy.
If we are the big player, and I guess this is off the jobs report tomorrow, on the American exceptionalism of strong nominal GDP, better than good fiscal stimulus. You know, we all know the story, but the answer is we're dealing with a technological excellence. Does the Fed pull that into their debate?
That's one of the debates about productivity. And because if you have high productivity growth, it's perfectly fine to have high wage growth and not have inflation. But if you have low productivity growth, you can't sustain high wage growth without there being inflation because the costs are going up relative to the outputs. And so that's one of the debates. Are we going to see productivity continue to be strong as we have over the last few quarters?
Is that the main reason, Randy, you don't think we're going to get to the Fed's target?
Oh, I think there are a whole variety of reasons. I think you've got expectations that never went up very much for inflation, I think, to the Fed's credit. So it never really lost credibility as the Fed did in the late 1970s, early 1980s. But I think it did lose a little bit, and people have kind of gotten used to asking for a little bit more in wages. And they also have to make up for having lost so much in real terms, inflation-adjusted terms, over the last couple of years. So I think there's going to be a catch-up in wages. I think nominal wage growth is going to be above the inflation rate, as it has been over the last few months. And that means at some point it'll be less exciting for firms to be hiring and holding workers. That employment rate will move up. And as you know, I've mentioned before, I think we'll probably have a hard-ish landing. Not a hard landing, but hard-ish.
So if you talk about the nodes of inflation that are stickier, that are going to be concerning to the Fed, that aren't going to allow them to cut as aggressively as some people are currently pricing in, is it particularly the service sector? Is there an area of inflation that you're focused on to sort of signal what you're talking about?
I think the Fed is going to be laser focused, exactly as you said, on services, as well as on the key thing that will be driving services inflation, which will be wage growth, particularly wage growth relative to the inflation rate, which until recently, until really maybe 4 or 5 months ago, had been nominal wage growth was below the inflation rate, and now nominal wage growth has been above the inflation rate. It's great for workers because they're getting increase in real wages, but that means that firms are going to be a little more reluctant to hire.
Randy, are lower prices, if oil, inflationary or disinflationary?
Well, certainly for headline inflation, it's lower. It helps to lower the headline inflation rate. But as we know, the oil prices have gone up, gone down, gone up, down, down, and so the Fed kind of looks through that, and that's one of the reasons why they look at the core numbers that strip out the more volatile food and energy sectors.
Randy, you're one of our giants in financial economics. Where we are right now, is it out of the textbooks you learned from, or post-pandemic, is this all original?
Well, I wouldn't say it's all original, but it's at least a little bit unusual. The amount of supply chain disruption we had, pandemics so far have only come along once a century, and hopefully it'll be another century before we have another one. And we've also seen an unusual resilience, not only in the U.S. economy, but elsewhere, to very significant interest rate increases. And so that's a little bit off of the traditional playbook. Is it a whole new playbook? Not so sure yet, but certainly it's pushed the existing playbook to the edges.
Professor Krosner, thank you so much. Randall Krosner, the former governor of the Federal Reserve System, in the midst of a claims and jobs day across Thursday and Friday. Stay with Bloomberg, particularly stay with Michael McKee for all of our reporting on this. Lisa, I mentioned the technological excellence that's out there. And Liam Denning, who's really good at technology and automobiles, writing for Bloomberg Opinion, said to me, he said, it's made for Brammo, and that's the Cyber Beast. The Cyber Beast is the enhanced new Tesla truck. He says it weighs the size, it's the weight of a white rhino and goes 0 to 60 down Central Park West in like 3 seconds or 4 seconds or something. Are they doing this in Asia? Are they doing this in Europe? Musk is doing this in America.
Yeah, because Americans are the ones that want to buy a truck. I just want to know where I can park that on the street. It's probably not going to fit in a traditional
it's
kind
where
of
you
parking
park
spot.
it where you want to, and everybody else adjusts.
Well, honestly, I just wonder how much this is going to be a piece for people who are Tesla bulls and real sort of Tesla adopters, and how much this is the future. All of our cars are going to look
people
like that.
know me. I've had the honor of speaking to Paul Romer, our technologist, I should say, in economics on this. We don't understand how unique we are in technology, which is $175 billion up into orbit, or what Musk is doing with the Cyber Beast, or what AMD announced today as well. Where is this stuff coming from? It's coming from America.
For now, and that's why I think it's going to be really interesting. It's not about gloom or optimism. It's about the global race to create something better. And there's been some pretty fiery rhetoric from the U.S. State Department and, frankly, from Gina Raimondo of the Commerce Department about how to prevent China from really making inroads in this area because of the concern around not understanding what this technology can do, even as it develops at a faster pace than people can wrap their heads around. To me, that is what I'm watching and trying to get a handle on.
Rumor that Brammo's in line for Cyber Beast. It moves the markets. We're up 5. Now we're up 13 here. NASDAQ up 0.6%. And, the good feelings there. 10-year yield was up 7 basis points, now up only 4 basis points. Are you prepared for $3.99 10-year yield?
I'm sorry, I can't move past the fact that you think that I'm going to buy a Cybertruck. I don't want a period object. Like, I don't want a statement, a sort of style statement driving down the street. Do you, of that nature?
Can you imagine the first time you and I see a Cyber Beast?
Exactly. People will just absolutely flood it. Ooh, who is this person? It's going to be, a celebrity.
We will have to see. An important discussion here on the American economy, and that is exports and imports. That would be the U.S. Trade Representative, more than qualified, Catherine Tai, this afternoon, 2:30 p.m. Tomorrow, Jobs Day. This is Bloomberg's Surveillance.
Bloomberg UK, your source for news and analysis covering is facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after. I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
3 days without gains on the S&P 500. Trying to change that this morning. Live from New York City. Good morning. Good morning. Your equity market positive 0.3% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up as the market prices Fed cuts, the BOJ considers hiking. Wall Street favorite Nikki Haley taking the spotlight, and SpaceX could be valued at $175 billion or more. We begin with the big issue: stocks meet gravity.
Stocks have just rallied too much, too quickly.
This rally is getting a little tired.
It's just kind of a chillax. It appears that Santa did come early this year.
Santa Claus definitely showed up early.
We've had the great rally.
This November rally.
Big rally we had in November.
It was very strong.
All of it is predicated on this idea that we're going to start to see rates move lower as soon as the first quarter.
It seems to be very strongly linked to moves in expectations around Fed funds rate.
Are they going overboard? Maybe so.
The markets have really pushed the envelope here to such an extreme.
The headwinds for the economy next year are woefully underpriced into market sentiment.
By the end of December, first weeks in January, that's when we get that uh-oh moment and that we went too far.
We'll see if the Grinch ends up coming in December.
Let's have that conversation right now. Morgan Stanley's Matt Hornback, Double Line's Jeff Sherman. Gents, always great to catch up with you both. Matt, first to you. I've asked this question a few times in the last 24 hours. Can the growth inflation mix get any better than this?
Well, we'll find out tomorrow when the non-farm payroll report comes due. But I do think that the mix is quite supportive for now for the types of price action we've seen in markets. But John, just over the past 5 days, we've seen equities go nowhere, rates go lower, and the dollar go higher. That's not a combination that sits very well with me. It makes me feel like the markets are sniffing out something more nefarious coming our way.
Well, let's get into that. Two things jumped out yesterday. Crude dropped into the 60s. And then, Jeff, we saw the 10-year at 4.1%. I think framing matters. I've talked about this a few times. I'm sure you have as well. Do you see that as ingredients for a re-acceleration in the economy, or maybe a sign that something nefarious is just around the corner?
Well, I mean, you can interpret it both ways. That's the challenge with it, Jonathan, is that, again, looking at the global commodity picture, it's not just oil, but if you look at the industrial metals as well, copper's really struggled too, and we use that kind of as a bellwether or a barometer of the global health of industrial production. And so as I look through it, I agree with what Matt said too. It is kind of strange that, we've had this high correlation, everything's been predicated on lower rates, and you didn't get kind of a fallout in the area. But if you look at the credit markets, I mean, spreads widened a little bit, but I don't think it's that nefarious there. But I think, as Matt said, we're all going to be focused on the non-farm payrolls tomorrow. The ADP report is a little weak. We've seen a big disconnect between ADP and NFP over the recent periods. So we'll have to see what that looks like. But the data is indeed slowing. And so you said, does it get any better? I think the only way it gets a little bit better is you have lower inflation. I think we have seen peak growth in this cycle on a year-over-year basis. And so I think what you're doing is seeing the settling in. I think we got a little excited about the rate moves upward, and now it's just been this kind of FOMO trade on rates on the way down that people, it's an under-owned asset right now. People hated bonds all throughout the summer, and once you got a little bit of a rally, you've seen a lot of people pile in.
Jeff, you mentioned the data. Let's talk about the data and how this market might respond to it. Tomorrow, 186 is the estimate. What is bad news for this market? What would it take?
Well, yeah, I think it's sub 100. I think if you get less than 100,000 or so, I mean, definitely if you get like something like 50 or something, that would be really negative. And I think you could really see us kind of test the 200-day moving average in the 10-year, which is closer to 4%. But in general, if you got something like a 225, 250, I think rates back up again. And then the question becomes, do stocks like it or not? Maybe because they haven't rallied for a few days, they do like it. But in general, I think that, looking at that data, I think it's important, but at the end of it, I just don't see the labor market slowing down completely yet. You look at continuing claims. It was a nice surprise that the continuing claims went down a little bit relative to estimates. And so, again, it's really a mixed bag. And I think that's why you're seeing such big swings in rate markets, is that you have this cross-section of economic volatility right now, that there's something for everyone, the bulls, the bears. But in general, I do think that we are indeed slowing, and the rate hikes are starting to really bleed into the economy, but they're just not completely there yet. And so the question is this a slowdown for real, or is it something where we are approaching that area? Because the bond market is now pricing in roughly a hike by the March meeting. It's like a 70% chance today. So I think the bond market is sniffing out that they want rate cuts. The question is it rate cuts for the sake of rate cuts, or do we need it because we are too tight in policy and the economic data is slowing and warrants those cuts?
Yeah, Jeff, you nail it. Not all rate cuts are created equally. Matt Hornback, if we get rate cuts, why are we getting rate cuts?
Well, I mean, it could certainly be for one of two reasons. One, it could be that inflation is just decelerating more quickly than the Fed had expected it to. We are thinking the Fed will lower its inflation projections when they meet next week for the SEP. And that should allow them to lower the level of interest rates that they're projecting in their dot plot. So it could be because inflation is coming down. It could also be because the unemployment rate has picked up more than they had thought it would. The labor market is a lagging indicator of economic activity, but inflation is even more lagging. And so you could have a situation in which inflation fails to continue to move lower in the near term, but the unemployment rate picks up more strongly than the Fed had anticipated, and that could result in rate cuts more than what the Fed is expecting to deliver at this point.
Unemployment tomorrow, the estimate 3.9%. Payroll's just around the corner. Jobless claims behind us. Mike McKee is with us to break it down. Morning, Mike.
Morning, John. Jobless claims not signaling a problem for the economy at this point, as both initial claims and continuing claims fall or stay in a range. Initial claims 220, up only 1,000 from last week, and you can see the downturn for continuing claims, 1,861,000 from 1,925. So at this point, we're not seeing any surge in layoffs. We do have a problem adjusting seasonally around this time of year, but in general, the labor market looks pretty much the same way it has for quite some time. We'll see tomorrow when we get some numbers. Affecting the markets in the meantime, though, we have this great 24-hour period before we get to the jobs report that'll affect the U.S. markets. It's the Japanese markets, because Kazuo Ueda, the Japanese bank governor, said in testimony to Parliament that their policy will become even more challenging from year end and heading into next year. Well, the markets have taken that as the end of yield curve control. They do meet next week, but they're not expected to do anything then. We get a new inflation forecast at their January meeting. The Shunto wage talks, this sort of countrywide wage increase that comes into play in March, could affect the March meeting. But right now you have people in Japan betting on a rate increase for the first time in April, which is pretty much where the U.S. market is for the Fed. So we'll see if we're getting contrasting monetary policy at that time. You can see what's happened with yield curve control. The markets are basically have pushed the yield curve out of the target, and they've sort of abandoned the target, but they haven't officially abandoned the policy yet. We'll see what happens. It's obviously having a major impact in the currency markets today, and to a lesser extent in the bond markets.
It's hard to call the JGB market a market. Mike McKee, we often say that. Mike, thank you. Check out dollar yen. Mike just said it. Dollar yen gap in lower. Biggest one-day move lower on dollar yen since the start of the year. A break of 145, 144.82. Matt Hornbank, this is your world. What should we be expecting from the BOJ?
Well, we do think the BOJ brings to a close both its yield curve control policy as well as its negative interest rate policy in January. The question for markets in what happens with dollar yen thereafter is how many rate hikes can the market price in for 2024? Now, our view is that the Bank of Japan will raise rates at some point later in the year, but there's a lot of debate about that. And you know how these markets go. You give the market an inch, it'll take a foot. And so we're really trying to figure out what is the appropriate amount of risk premium for the bond market to price in for a continuation of rate hikes, and then how easy will it be for the Bank of Japan to deliver those rate hikes, provided that the ECB and the Bank of England and the bank and the Federal Reserve are all cutting rates mid-year. That's going to be quite a challenge, because you can take dollar yen a lot lower than what we've seen just over the past week or so, and then all of a sudden that raises questions about the sustainability of the imported inflation that has ultimately crept into some of the underlying metrics that the Bank of Japan has been so focused on.
Jeff, limited spillover to treasuries this morning. Yields up across the curve, but only by a handful of basis points. That's kind of been an average move over the last couple of months, I imagine. From the standpoint of you and the team, Jeff, what kind of spillover would you expect from what's developing in Japan into developed markets elsewhere?
Yeah, I think, you know, there was this idea that, you know, that starting to price the hikes in Japan were leading to some of the rate move we saw over the course of the late summer, early fall here. But ultimately, I think, you know, you're talking about a convergence of policy. As Matt said, the expectations are for the BOJ to hike, and you have the Federal Reserve cutting. So that's why you see this kind of wild move in the yen today as well. But I just don't really see there being a lot of spillover effects. I mean, I don't really see this idea that ultimately there's going to be this massive repatriation of the Japanese holdings and treasuries back to their own local currency at this stage. And so I think some of that move has happened in like corporate markets. We see that anecdotally about the demand for the Japanese investors, not really as much the overall pension system, but the bigger investors. Ultimately, I've been buying European corporate bonds. So I just don't see there being this effect of a spillover to the treasury market at this stage. Maybe the treasury market's a little overbought just given the momentum. If you look at strength and RSI kind of stuff. But in general, I don't expect there to be some meaningful pushback and U.S. rates to go up because there's this massive selling because people want to go back to the Japanese currency.
Jeff, it's another anchor, though, that's been around the neck of the global bond market for the last few decades that's potentially being dropped. And I just wonder, as you look out to next year, do some scenario analysis with us. If we get that economic downturn in America, do you see limits to the Treasury rally at the long end, given the forces elsewhere?
Yeah, absolutely. I mean, because you know, the rhetoric over the late summer was the sustainability or the tenability of the deficits that we're running in this country, and it's on every trader's mind, it's on every portfolio manager's mind, and that there needs to be some more term premium in the market because of this increased supply. So it's a technical issue, but you have to find demand, and demand comes when you essentially have the right price. And so what I would see is that we expect to see, if there's an economic downturn, a rally. But as I say, you don't really want to own 30-year bonds for 30 years. We want to rent them. We want to rent them for a rally. I do think they do have a meaningful move, But I think the magnitude of that is less than what we've seen in previous cycles, because now we're back to having a world that we've seen inflation. We know that the fiscal response could be massive, and I think that will be on traders' minds as well. So I do think you still get a rally. I just think that it's not as meaningful as it would be in past cycles, because again, we've seen inflation. We need to price inflation back in the market, and we see that if there is a big dose of fiscal, which we've had a constant fiscal dose really for the last decade, but if they do it in the magnitude, if you just did half of what we did during the pandemic, I could see you getting a sharp reversal in rates. And it's probably the pressure valve there would be the dollar. And so the way I would try to play that through that is you want to own the rates going into it. You want to be long the dollar, but effectively, if you start to see that fiscal response mechanism, ultimately that's your cue that it's time to really start looking at the international markets and get out of some of the dollar and probably get out of some of those back-end rates positions. We've moved our key rates down a little bit with this rally, the stuff we owned in the back end. We think a little bit of this went a little far, but again, we still own duration. We just moved it in the curve a little bit more to like the 10-year and 20-year parts of the curve.
Interesting. Save that dollar call because Matt Hornback, I know, has thoughts. We'll get to them in just a moment. Matt Hornback, Jeff Sherman. Looking at the market right now, equity futures positive by about 0.3% on the S&P. Let's get you some movers. Here's Abby.
Helping that positive tilt, John, let's start off with the shares of JetBlue. They are up more than 8%, or at least the last time that I saw them. This after JetBlue, the airline company, tweaked its fourth quarter guidance to a narrower loss on both the top and bottom line. They're talking about healthy travel demand, and that's why they're able to boost that fourth quarter revenue guidance. AMD up nearly 3%. They unveiled their AI chip yesterday at their big event, a competitor to NVIDIA, and I think also investors really liking the fact that CEO Lisa Su said that the AI chip market could be as large as $400 billion over the next 4 years. To the downside, though, Nikola down 23%, plunging on its plan to raise capital via both stock and converts. The former leads to dilution clearly. The latter could. The stock into today down 55%. There's a 20% short interest. Tough year for Nikola, John.
Abby, thank you. Great interview with Lisa Su and Ed Ludlow. We'll bring you some of that. We'll catch up with Ed in about 15 minutes' time. Look out for that. Coming up next on this program, Haley under fire in Alabama.
You have other candidates up here like Nikki Haley. She caves anytime the left comes after her, anytime the media comes after her.
She should come nowhere near the levers of power, let alone the White House.
GOP candidates targeting Nikki Haley as she continues rising in the polls. That conversation up next.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
You have other candidates up here like Nikki Haley. She caves anytime the left comes after her, anytime the media comes after her.
The only person more fascist than the Biden regime now is Nikki Haley.
When she was governor of South Carolina, she was the #1 ranked governor of bringing the CCP into her state.
She should come nowhere near the levers of power, let alone the White House.
Her donors, these Wall Street liberal donors, they make money in China. They are not going to let her be tough on China, and she will cave to the donors. She will not stand up for you.
Nikki, I don't have a woman problem. You have a corruption problem. And I think that that's what people need to know. Nikki is corrupt.
I love all the attention, fellas. Thank you for that.
She was sharp last night, and Nikki Haley taking the spotlight at the 4th GOP debate, willingly or not. Her opponents criticizing her ties to Wall Street, Haley's major backers including JP Morgan, billionaire Bill Ackman, industrialist Charles Koch. Even with that support, she's still in a distant second place compared to frontrunner Donald Trump, who hasn't attended any of the debates. The latest Wall Street Journal poll showing the former president with an unchanged lead of 59% and Haley rising to 15% in recent months. Bloomberg's Anne-Marie joins us now from Washington, D.C. Morning, Anne-Marie.
Good morning, John. Well, it's the race for second place, and given the momentum we have seen from Nikki Haley, amongst those 4 that were actually on the stage, I guess we should potentially call it a candidate forum rather than a presidential debate. Nikki Haley was the one that drew all this criticism, especially from Governor Ron DeSantis and Vivek Ramaswamy. They went after her in terms of Wall Street donors that are interested in her, even a potential billionaire Democratic donor who gave $250,000, Reid Hoffman, to her super PAC, and also for her hawkish foreign policy. At one point, Vivek Ramaswamy called her a fascist neocon with lipstick. She didn't let it bother her. She said, I love all the attention, fellas, and at one point even said they were jealous for all that attention and the donation she's getting, because those Wall Street donors, remember, Jonathan, about 6 months ago, thought potentially Ron DeSantis was going to be their guy, and they're now looking to Nikki Haley.
MH, when you look at the backers, the likes of JP Morgan CEO Jamie Dimon, are they backing her because they want her to beat Biden or they want her to beat Trump? And does that help her win these primaries?
I think it depends on who you ask. But when you look at some of these major Democratic names, there's a potential they're going to vote for a Democrat when it comes next November. But they are concerned that if Trump becomes the nominee, obviously there's potential that he could beat Biden. And you see how well he's doing in the polls, especially when you look at our polling of swing states. Trump is leading in a number of these swing states where elections are won or lost. And that is why there is growing concern. That's why you see some Democrats saying, for the health of the country, we should make sure there's an alternative to the former president. Former president, though, Jonathan, yesterday didn't do counter-programming. He didn't care. He had a private fundraiser. And if you look at the latest Monmouth University polling, when it comes to Republican voters, 63% say they want Trump and only Trump. 28% say they want a contested election.
AMH, thank you. Down in Washington on the latest. Matt Hornback, Jeff Sherman with us for some final thoughts. Matt Hornback, messy politics potentially next year, big deficits. We're talking about the prospect of rate cuts and slower economic growth. Matt, you like the US dollar for next year. Just walk us through it.
Yeah, absolutely. Well, we think there's a couple of things to like about the US dollar. Number one, it's certainly one of the higher carrying currencies in the G10 complex, and carry is king at this point. So we like the dollar for its carry, but we also like it for its defensive properties, John. If we have a U.S. slowdown that's occurring at the same time that Europe continues to be quite weak and China is having difficulty rebounding despite all of the stimulus that's been thrown its way, that's not a great environment for global risky investments. And so we think that the dollar can benefit from that type of environment as well. The real risk to this view, of course, is that the Fed, has already made a policy mistake and finally figures it out. And so to the extent that we have the Fed cutting rates more aggressively than Seth Carpenter and Ellen Zentner are calling for at this point, that would certainly be a risk to our view for the dollar. But for the time being, we think the dollar will continue to grind higher from these levels.
Jeff Sherman, are you on the same page?
Yeah, I am. I just think that the market's a little excited about these cuts. And, I've said it before on the programming here that, when the Fed cuts, I think there has to be a meaningful cut. And this idea that there's going to be some preemptive cut to tweak policy and do it around the margin, I'm just not in that camp. And, you know, when we look through it, I mean, look, the reason Jay Powell brought up something like Supercore is because he knows it's got some sticky attributes, I believe. And so it allows him to keep that policy. So I think by the time, in order to get a Fed cut, you've got to see some meaningful degradation in the labor market. And as Matt pointed out earlier, it's one of the most lagged variables besides inflation. And so the stickiness of the super core, yes, it's trending downward. Yes, it's sub 4 at this point, but it's just not where it needs to be. And, you know, if you look at services inflation, it is even in core CPI, it's still pretty sticky. So we think inflation, you know, the headline level goes sub 3 in the first quarter, but I don't think that's enough to get the Fed to do some sort of preemptive thing. They told you there's going to be pain. They want to be tight. And Jay Powell's legacy, he doesn't want to be thought of as someone who caters to, you know, the administration or caters to the overall kind of the populace and the markets. And him talking about financial conditions in the last FOMC press conference, I mean, look at how the financial conditions have moved against him in his face.
Right.
And so I kind of expect him to sound hawkish. I don't think there's much that he does, but I just don't think, I think he's trying to tell the market that we're not delivering a cut, quit pricing it in, and I think you get some whippy behavior off of that.
Big news conference next week. Jeff Sherman, Matt Hornback, gents, two of the very best. It's great to catch up. It always is. Coming up on this program, the morning calls and later, SoFi's Liz Young calling it a market of big contradictions. That conversation still ahead.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Stocks are positive across the board here. That's some of the price action. Let's get you some morning calls. Your first one from Bank of America, downgrading Take-Two to neutral, assuming a later launch of its highly anticipated GTA video game. Goldman Sachs initiating coverage of Avis with a sell rating, pointing to a negative risk-reward and limited upcoming catalysts. And finally, Stifel initiating coverage of Rivian with a buy rating, $5 price target, expecting headwinds to start easing over the next few years. That's stock positive by 3.9%. Coming up, SoFi's Liz Young seeing a challenging start to the year for stocks. That conversation up next. Your opening bell just around the corner.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Authorities.
Could face bigger challenges next.
Was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
24 seconds away from the opening bell this morning. Good morning. 3 days, no gains on the S&P 500. Let's see if we can make a change to that. On the equity market right now, futures session highs going into the opening bell. Equity futures positive by around about 0.5% on the S&P. On the Nasdaq 100, futures here positive by almost 0.75%. There's your opening bell. Switch on the board and get to the bond market. Yields shaping up as follows on a 10-year. Yields higher by 5 basis points. 4.1533. Yesterday, this market spooked by 4.1% on a 10-year and crude in the 60s. We unwind some of that. WTI $70 and about 20 cents, up by 1.2%. Is it all about supply or is it all about demand? Depends how bullish or bearish you are right now. But intriguing to me that people were saying it was all about demand, yet stockpiles yesterday were falling. In the latest data we got from the government, $70.24. My opinion on this does not matter. Paul Sankey of Sankey Research says this is all about supply and not demand in this oil market. More than 13 million barrels a day of crude production in this country right now. In the FX market, 107.80, Matt Hornback on the euro sees potential to go to parity in his latest research. We're just a little firmer here by 0.1%, a stronger euro trying to make a comeback from recent declines. That's the cross-asset price action about 50 seconds into the open. Positive here across the board. One stock to watch at the open, Dollar General. Shares moving higher on better than expected Q3 results. Abby has more. Hey, Abby.
Hey, John. Better than expected and better than feared. As a result, the stock, to your point, is up 4%, the best day since the middle of October. And it really has everything to do with the fact that numbers were better than Wall Street estimates. In terms of same-store sales, they fell 1.3% versus the estimate of a 2.1% decline. They also beat earnings estimates by about 7% to put up $1.27 in adjusted earnings on about $9.7 billion in revenue. They backed, importantly, the guidance for the full year. This company's really been struggling. The CEO highlighted significant headwinds that they have made relative to inventory shrink. They've also made momentum in some of the underlying sales trends, positive customer traffic, as well as market share gains in both dollars and units. Now, looking ahead, they do have more than 2,300 real estate projects that they're planning in terms of opening new stores, remodels, relocations, and to make other improvements. That's what they're looking to do, John. Into today, it's been a tough year, down 46%. They've got their work cut out for them. Small start, stock liking it right now, up 4%.
Nice little pop. Abby, thank you. 2 minutes into the session, let's stick with earnings. GameStop reporting sales that fell short of estimates. Alex Semenova has the story. Hey, Alex.
Hey, John, good morning. Well, it was that sales number that was driving shares of GameStop lower this morning, coming in at just under $1.1 billion below Wall Street estimates and down 9% from the same period a year ago. GameStop missed in sales on all three major categories, that's software, hardware, and collectibles. Now, analysts said that this report was mixed, although they flagged revenues that missed estimates. They did highlight costs as a positive. Baird Equity Research said that the company is right-sizing its stores and headcount. Jefferies pointed to notable cost discipline. Now, John, get this. The company also said that the board has given CEO Ryan Cohen permission to invest in equity securities and manage its investment portfolios. Wedbush called this the most inane move they've ever seen. They said that we don't need GameStop acting like a mutual fund. John?
Alex, thank you. Thanks for the update. The stock is down by around about 6%, down about 25%, I believe, on the year so far. Let's turn to AMD, the chip maker unveiling a new AI chip after giving a monster forecast. Ed Ludlow wakes up early for us. Morning, Ed.
Yeah, good morning, Jonathan. AMD up more than 3%, putting it on track for its biggest jump in about a month. It's curious because the announcement was yesterday lunchtime and the stock actually closed lower on Wednesday. But the crux of it is that the MI300X, the new AI accelerator, is a direct competitor to NVIDIA's H100, the GPU that we've been talking about all year. It has a technological advantage in that the AMD GPU has something called HBM3, which is the latest cutting edge of high bandwidth memory. High bandwidth memory reduces latency, it makes it more power efficient. And when I was chatting with the CEO, Lisa Su, yesterday, the main point is that it's a cost competitive product against NVIDIA. In fact, on stage, Lisa Su spent most of her time explaining why on various factors the MI300X was better than NVIDIA's current generation H100. NVIDIA plans to catch up on HBM3 or high bandwidth memory in the second quarter next year when they come out with the H200. What's pleasing the analysts is they gave us some meat on the bones of who's actually going to buy this GPU. It's not just Microsoft Azure that's going to be a cloud customer. Meta is going to put the MI300X into its data centers, and there's also a relationship with OpenAI in terms of the cloud tools they offer to developers in building AI and other software materials. Now a big move, up 4.3%, somewhat delayed. The headline that you talked about, they've upgraded their 2027 call for the total addressable market for AI accelerators to $400 billion. Just in August, they said it would be $150 billion. I asked what's changed. The demand has changed. It's increasing exponentially, John.
Ed, great work with Lisa yesterday. Just how surprised were you to hear numbers like that?
Surprised in the sense that we knew about the MI300X. I think that the only new information really beyond the updated forecast for 2027 was who the specific customers are. Remember, there are still some supply constraints, right? The contract manufacturers like TSMC are not able to build the total volume of GPUs that names like NVIDIA want. So that's a factor in it. One key note of caution, they did not update their financial guidance, right? They still see $2 billion of sales in 2024 AMD on the MI300X. And I asked Lisa, well, if you're going to upgrade your 2027 call by that extent, why not upgrade the 2024 call? And she said there is certainly room to surpass that $2 billion target.
Interesting. That's what's behind this move this morning. Ed, thank you, sir. We're up by, let's call it 4.5% on AMD. This is real. It's not just a hope and a dream. It's real. That demand is coming. It's materializing. You see that in NVIDIA all year. Let's stick with AI. Alphabet releasing Gemini, its latest and most powerful AI model. Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yeah, we're seeing a delayed reaction here in the shares of Alphabet as well after Google rolled out its Gemini AI model. It did that yesterday, and there was a pretty muted reaction, but now we're seeing a substantial move higher in these shares. Now, Google invented the technology behind the current AI boom, but OpenAI and its ChatGPT and DALL-E have really taken a lot of the popularity. So Google wants to get back into the game with rolling out this Gemini AI model, which is usable through the for the public through the chatbot Bard. There are 3 different versions of this technology, and not all of them have come out. One, Gemini Pro, that's currently accessible through Bard. Gemini Nano will be accessible for Pixel 8 Pro, Google's flagship phone. But Gemini Ultra is the one that everyone's paying most attention to. It is not currently available for the public. It will be rolled out to enterprise and developers, but not for the public until until next year through Bard. That's the one that is, according to Google, more powerful than ChatGPT-4. It's natively multimodal, meaning it was pre-trained to take inputs that are both text and images and do stuff with them. The goal here for the company is the AI that feels more like a helpful collaborator and less like a smart piece of software. Again, we didn't see a big movement in the shares yesterday, and JP Morgan says perhaps this is because some analysts viewing this product as not quite complete and the fact that Ultra has to come out next year. But BI's Mandeep Singh pointing to the potential distribution advantage for Alphabet versus OpenAI. So maybe markets just slower to process this news, and that's what investors are computing this morning, John?
Tony's better this morning. Simone, thank you. Just a lift across the board here. The stock is up by more than 5%. The broader market up by 0.5. The Nasdaq up by 0.9. Here's the outlook. This was the conversation I've looked forward to all morning. SoFi's Liz Young weighing in on the state of markets and writing the following. Markets are wrapped up in contradictions, at least for the rest of the year. And the glass half full side is still winning. Liz, I'm pleased to say, join us right now. Liz, I've been talking about your note a little bit earlier this morning, a market of massive contradictions. Can we just pick out a few of them?
Well, you've already covered a couple of them. Think about the oil market. We've got oil prices falling at a time when cyclical stocks have rallied and started to really catch up to those top big tech names. So the stock market seems to think that cyclicality is still alive and well. The oil market is a little confused about that, and we're having a debate over whether it's supply or demand driven. And then you've got things like just markets versus the economy in general. Obviously, we've seen a really strong rally in markets this year at a time when we've intentionally cooled the economy. Now, things have held up better than I think many expected, but we were welcoming and are still welcoming some cooling in the data. So there's a little bit wrapped up in that. And then if you look at things like just holiday spending, so some of the topics of the moment, we had retailers come out with Q3 earnings and a lot of their outlooks saying that they were worried about demand softening. They hadn't built up quite as much inventory, and they'd really cautioned about results being lackluster. And now we've got holiday results that are saying consumers were spendy before, they're still spendy now, and things are doing okay.
Liz, let's go through that. 3 points there. The broader market, the relationship with the economy, then we've got crude and what's happening with the consumer. I want to talk about the consumer. What's important to you? How much they're spending or how they're spending? Does buy now, pay later mean we should be concerned?
My personal opinion is yes, it does mean that we should be concerned. Now, there are all different types of deals out there in buy now, pay later. You can do it at 0% financing, or you can do it at 18% financing. I would argue, though, if people are only doing BNPL for a couple months, what would really be the point? Unless they're taking that money and investing it into something that's going to earn them more over that couple month period and engaging in some kind of interest rate arbitrage, which is not what I think is happening, then I do think the BNPL, the growth of BNPL, particularly this holiday season, on the heels of so much growth in credit card debt, auto loan delinquencies in the subprime sector, it's just all adding up to tell me that consumers are starting to overspend, if not already overspending. So that may not come home to roost this year, but in January and February, when some of those bills